A German construction effort could be in focus today, and a European construction effort, to be fair, as well. Adidas could be a different story. We see Adidas, their numbers underwhelming, so how much will that be a different story? We see also that traders are no longer fully pricing 3 ECB rate cuts this year, so how much of an assumption towards growth do we make coming off this German fiscal impulse then?
Absolutely. All of that needs to be factored into a market that has been on a wild ride over the last few days. You've seen the hit the tariffs have caused over in the North Atlantic region. Are we about to see that here in Europe as well? So here we go. We're going to have to wait a while, I suspect, for the German market to open. But the FTSE 100 already in positive territory. The IBEX out of the gate very swiftly this morning, up 1.5%. Now, remember, yesterday was a really bad session for European equities. We are going to get a reaction to that, but there's so much other news flow that we need to fold into the narrative too. So there we go. The Stoxx 600 up by 0.1%. The European markets are climbing. The London market is up by 0.3%. But on the continent, the IBEX is already up very, very strongly. The CAC is up by 1.6% as well. Be interesting to see how European defence names trade broadly today in reaction to that German announcement. But I think it's going to take a little while to get the DAX going this morning. There's a lot of news flow to fold into that story, Lizzie.
Yeah, as we wait for Rheinmetall, let me take you through some of the other defence names that are already trading this morning, guys. So you've got Leonardo up 2.4%, BAE Systems 1.2%, Thales 3.5% up, Safran, Airbus, Saab, Indra, Sistemas, all strongly in the green this morning. And then if we look to some of those earnings names that we were discussing as well, Dassault Aviation up 2.9% already, Bavarian Nordic up 0.8%, Anna. So we're already powering ahead in this session.
Yeah, absolutely. So that's the defence side. The wider infrastructure side and the growth narrative clearly catching on, because basic resources is the best performing sector this morning. ArcelorMittal up by more than 6%. Some of the mining names up pretty strongly as well, up by more than 2.5% for the top 5. The banking sector also doing well this morning, up by 1.7%. Now, if we don't see so many rate cuts in Europe, then that plays positively for your net interest margins, doesn't it? And so we see Spanish banks going higher, we see Italian banks going higher. So this isn't just a German story. There's something wider happening here in Europe.
No, and indeed you have the hopes of China stimulus powering the miners too. Iron ore has seen the reaction already, so that putting a bit of wind in the sails of basic resources, up nearly 2% there.
Is this just all the good news? I keep coming back to this tariff story and the turbulence that has been caused in North America. You look at what Canadian assets did yesterday, what Mexican assets did yesterday, what Wall Street did yesterday on the back of the tariff story. Europe feels like it's next, yet at the moment we're looking to the good but not the bad.
Yes.
Does one inevitably follow the other?
And going back to your question earlier, Lizzie, about whether what Europe does on the defence side can give them wins on tariffs, does it make the White House think along those lines? Or does it make the White House think, look what we managed to do on defence, let's see if we can do something with tariffs as well and get something for US business? So many questions, so many questions we can't even think of around tariffs right now because we don't know what the next 4 years are going to be.
The effect has been enormous.
It's only March.
It's only March.
2025.
Well, I can't remember how many days we are already into the Trump administration, but it's not that many. There is a long way to go in terms of this story. And the narrative yesterday seemed to be actually that Trump was still keen on this story of tariffs, that he felt that it was going to make America rich again, that was the longer-term picture. This is not a short-term phenomenon. The German market opens. It is up by 2.16%. Let me give you a GIP on my screen just to give you an idea of what the last 3 days, because I think you need to sort of take a step back and think about the totality of what we are seeing here. So on a 3-day basis, i.e. this week, Monday, Tuesday, Wednesday, we are up by 1.1%. The German market gaps higher this morning after a big move lower. Does the volatility continue And is that a concern as well?
Yeah.
Like the price action at the moment is all over the place, and it's really difficult for the market to get a handle on what is happening here. And is that a negative in itself?
Right, and construction and materials, the best performing sector. So this is broader than just defence. So Hotif, Heidelberg Materials, all of those kind of names. Some of them listed in the UK as well. Kingspan, these are all construction-related businesses, and all of them going higher. That is the best performing sector this morning, along with industrial goods and services in second place. But gilt markets, are they catching something from Germany this morning?
Yeah, indeed, they're tracking. So if you look at the 10-year gilt yield, higher 9 basis points at 4.6%, the 2-year up 8 basis points at 4.26%. So not far behind the moves that you're seeing on Bund yields this morning. We already had all the announcements on UK defence spending being increased by Keir Starmer ahead of his Washington visit, but clearly catching a vibe off what Merz has said yesterday.
But it's a different story. The UK debt to GDP number is significantly different to the German number, which is in the kind of mid-60s.
Well, that takes us to what Val was saying. You know, if Germany can handle this, that maybe is the conclusion from the bond markets. Yeah. But can other parts of Europe, can Italy, can France, can the UK? I mean, these things have unforeseen consequences, don't they? And we wonder how this ripples around Europe.
I was listening to a German news podcast the other day, which put it more bluntly, Britain's broke.
Okay.
You see this reaction.
Okay, let's talk about what is happening in these markets in a little bit more detail. Estelle Menard, the CIO at LCL, joining us. Estelle, good to see you. Thanks for joining us and taking the time to be with us today. European bond markets, we are seeing yields going sharply higher. European equity markets are up today. What do you make of the European trade? What is the best way to position for this going forward? And does the move that we're seeing at the moment continue?
Well, we've seen a strong move since the beginning of the year on the European market because it has been really surprising for most of the investors that were invested on the US market to see this rebound. But if we look at what happened over the past 2 or 3 years, I mean, since 22, on $100 that went out of the European market, only $3 came back on the European market. So what does it mean for us? It means that the European market is still very interesting, and we still have to look at this market that shows an under-evaluation compared to the US one. So we need to invest in this market, but yes.
Okay. How cautious do we need to be, though? We are seeing significant volatility. The price action is one day up, one day down. We still don't know what the European tariff story looks like for Europe when it comes to what Donald Trump is going to do. How much volatility should investors expect?
Definitively, these tariffs create uncertainties and strong volatility, and we will have a bumpy road over the next 2 or 3 months, or even 4 or 6 months. But so strong volatility. What does that mean for us as investors? We will find some interesting entry points on the market, on the European side, but on the US side as well.
So Estelle,
that's first
points?
my understanding of the market.
If you're going to move money into defence, and if you're going to move money within Europe, let's say into defence and infrastructure, does that mean that you take it out of luxury, for example? Because I'm looking at the luxury names up today.
Well, of course, if we look at what happened on the defence area and the defence sector, it will be sustained in the coming years. Not only in 2025, but in the coming years, because it will be a long trend to impact all this sector. But sure, we will need to invest. Europe is investing in the European sector. We will finance this investment by bond issuances, and we need to invest in this as investor in this area if we want to benefit from this strong demand that we will see in the next years. Do we have to sell the luxury sector to invest in defense? I'm not sure about that. We need to wait for what will happen in China, and we will see in the next hours if there is something a new plan that will impact China. So I'm not sure we need to make an arbitrage between the defense sector and the luxury sector. We just need to invest in some undervalued sectors with a strong potential. And if we look at the momentum and the EPS momentum, they are strong, even in the defense sector and in the luxury one. So we have to look at the EPS growth. And EPS growth is really an interesting point if we want to invest in the equity market. Bear in mind that we expect 12% EPS growth in the US for 25, 8% in Europe for 25, and I do not integrate the dividend and the share buybacks. So that will be very interesting for investors to look at the bumpy road and the uncertainty that will create volatility and create entry point on some very interesting sectors that have not been sustained or that have not been of interest in, over the past years.
Yeah, okay.
Although
so maybe
it can be in the
from
US and in Europe.
Into Europe, yeah.
Excuse me?
Also looking ahead to this ECB meeting tomorrow, Estelle, apologies for the delay. We've got traders no longer fully pricing in 3 ECB rate cuts this year. I just wonder whether, given this announcement on defence, you're maybe positioning, thinking about tomorrow's ECB cut being the last.
Yes, it could be the last, but I do not think it will be the last one, because if we look at the economic growth today in Europe, it's still a very low, expectation are still very low, with 1% economic growth. And if we look at the defense investment we will see or will make in Europe, it will have an impact on the economic growth, not in 25, but in 2026 and beyond. So what does that mean today? ECB regarding the trend of the inflation, which is a downward trend in Europe, and the economic growth, I think ECB should have to cut its interest rate, and not only once, but certainly 2 or 3 times this year.
Okay, Estelle, I'm thinking about what reaction Germany's spending plans might get in Paris. I'm sure there are many who will be pleased that Germany is going to be spending more, doing fiscal stimulus. But will the French government be pleased with a higher interest rate there? We see OAT yields up by 12 basis points. How does this make you think about OATs right now?
Well, regarding OATs, in our portfolio, we were not very sensitive. You know, we had a very low duration because of this environment, which was not very, sustainable, not very interesting for us. So we were most on the short side of the bond market. But if we look at what will happen, and if we look at the defense proposition or defense spending, we can expect in Europe, sure, this will impact the sovereign bonds. European sovereign bonds. And if we look at what we can expect in terms of spending, if we make spending coming from 2% of the GDP to 3% of the GDP, what does that mean? Between 6 and 13 or 15% increase in the bond issuance in Europe. And I think that it's fair enough, and it can be absorbed by the market.
So, great to catch up. Thanks for joining us, Estelle Manat, CIO at LCL. Thank you very much indeed. Quick look at the Core 6. What is happening across Europe? This is the big picture. These are some of the heavyweight stocks that we are watching. And as you can see, broadly, we are higher. The defensive names maybe are not actually where you see the bid this morning, so no surprise maybe to see Nestle a little bit softer. But luxury is bid, to Lizzie's point. We're also seeing chip stocks higher, which is interesting given what is happening with the announcement that we got from the United States yesterday on the CHIPS Act there. But pharma's up, luxury is trading higher. Even the car sector may be catching a bid too. Schneider up by nearly 3%. But the defense stocks move is one we want to watch out for. Construction more broadly in Germany. Let's get the details with Joe.
So we are seeing some big moves, as you say, Guy, in the German stocks, specifically in the construction sector. Take a look at some of these moves. We've seen Heidelberg Cement up around 10% at the moment, Bilfinger 16%, Hochtief gaining 10%, and ThyssenKrupp as well, up 8%. Now, all of this spending really feeding through into the market, quite stark in terms of the numbers coming out of those spending headlines on Germany, and actually still seeing a bit of a gain coming through into the defence shares as well, despite the massive gains we've already seen year to date. So Rheinmetall now up to well above 1,150 euros. Also, the other firms, Hensoldt and Ring, getting a boost. But the construction, industrial stocks, really the big trade from Germany today. Then over to Samba Trainers, Adidas. This one is slipping. They are known to be conservative on the guidance, but the market's still not liking the update from the company today. The guidance looking a little bit soft, missing expectations once again for Adidas. So that one coming down, trimming some recent gains for that stock. Then over to tabletop elves and goblins, we've got Games Workshop up 8%. Now remember, this is now almost a £4 billion company in the UK, recently added to the FTSE 100 as well, and continuing its surge on the tabletop game sales for the firm and really extending that rally. Good numbers out of them once again. Then finally on a morning call, Barclays, now that one up almost 7% as Exane goes to outperform, but also bear in mind we are seeing a move higher in the gilt yields this morning, potentially feeding through. Banks had a terrible day yesterday, one of the worst sectors on the day, and was down the most in around 7 months. So all of those stocks coming back up, and Barclays getting an extra boost as Exane goes to outperform on that one in the UK this morning.
Tabletop goblins was not something I thought we were going to be talking about this morning, but Joe, thank you very much. 8:14 and European equity markets responding strongly, positively, but of course in the context of that big sell-off yesterday, we're up by 1.2% on the back of the German news flow, up by 2.7% on the DAX. We'll go to Germany once again next. Coming up, Hensoldt shares surge along with other German defence and industrial companies. We'll talk to the CEO next. This is Bloomberg.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's emissions.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
We are in an era of rearmament. And Europe is ready to massively boost its defense spending, both to respond to the short-term urgency to act and to support Ukraine, but also to address the long-term need to take on more responsibility for our own European security.
Former German Defense Minister, now President of the European Commission, Ursula von der Leyen, speaking this time yesterday. Since then, we've seen significant announcements coming out of Germany as well. We are going to see carve-outs, both at a European level and at a German level, from the fiscal rules. Oliver Dorrer joins us now. He is the CEO of the German defense company Hensoldt, and it is great to see you once again, Oliver. What did you make of the announcement?
Thanks for having me.
Quickly do you think... How quickly does this money get spent? Germany's talking about 500 billion. How quickly do you think that money comes?
Well, of course, we all know that what the main future coalition parties, the Socialists and the Conservatives, have agreed yesterday needs to go through the parliament. So we need a two-thirds majority. I think they have a rash plan on going through this next week. Then the next step will be the capability list. So very clearly, we see a paradigm shift in Germany. The past decades have been more or less ruled by the principle of design to budget. Now we're designing our armed forces, our defense, to capabilities. That's what we need to work out. And then I would say we can be very quickly on bringing this up.
How quickly? Okay, so we're designing for capability now. Clearly, there is a need for significant amounts of kit for the armed forces if they are going to be a credible deterrent. In terms of how long that is going to take, there is a need now to do that, but it takes a while to get German defense companies spun up, to get the training done, to get the factories built. We talked about this last time. Is that process accelerating now, and how quickly is the rate of change developing?
Well, I would see a kind of spiral approach. I mean, looking at Hensoldt, as I told you last time, we have invested 1 billion recently. We took responsibility. So the commitment, whatever it takes, is very rewarding for us. And so with what we have done, building a new plant in Oberkochen, building a logistical center in Leiching, with all of that, I think we scaled a bit above the current demand in anticipation of a 3 to 3.5% spending. So we have like 50% additional capacity that we can bring immediately into this game. And in that regards, we will take, of course, the next step on investment as the orders turn in. Coming back again on this spiral, I think we have a couple of programs where we go into framework contracts. I think here very quickly, based on the budget availability now, we can order these additional, looking at the 20 Eurofighters. We have a program called Pegasus, where we produce 3, but we have options of additional 3, maybe 6 aircraft. So I think those orders can come in very quickly. And there's a new portion, as there will be a mix of I would say, classical, conventional, which is tanks, aircrafts, and ships. There will be also a portion of innovative things. I mean, going into space, not relying anymore on the US, innovation with regards to AI, building data networks. I think also here we're well prepared, and we have to work those capabilities out.
Oliver, is there, I'm just trying to get a sense of how much of this money, European and German money, will stay in Europe and how much of it might go elsewhere. In the short term, will there be a need to pay Americans for arms?
Well, I think, first of all, we see a very strong alignment between what Germany says, releasing the debt brake now for the defense budget, which I think is a very strong commitment, not putting a ceiling. Then we have EU with the rearm plan of Ursula von der Leyen, and I've been to Brussels on Monday, and what I hear is definitely there's a lot of buying Europe, and of course also the German plans are to reinforce the economy, buying in Germany. But on the short to midterm, very clearly also operationally, we do depend on the US. So, I mean, also Germany has heavily invested under the first extraordinary budget into US technologies. But I think here we will have a strong call, and we are working with the US players, we will have a strong call of sustaining those capabilities through German and European partners.
Okay. Will you be thinking about adding other product lines, Oliver? Because your focus is around electronics and things related to defence in that area. When Ursula von der Leyen was talking yesterday about ammunition, drones, vehicles, how does this change your business?
Well, I think I'm a big fan of strengthening strengths in that regard. I think also with our need now to deliver at scale, we will remain focused on sensors. Of course, we broaden the sensor landscape. Here we are open, also looking at M&As and a couple of topics. But I think the more important thing is going to smart and connected sensors. So being more software, more data-centric. That's what our strategy North Star is about. And I think that is where we will invest and where we will put our focus as we go forward, because that's the innovative part of now spending budgets, as we will never cope with a spiral of a war economy, bringing platforms and so on. I think it's really about smart arming, and here I think Hensoldt will come into place, and that's not about entering additional branches.
Oliver, good morning. Lizzie here. I'm going to be optimistic here and ask you, however far away it may seem now, if we do get peace in Ukraine, if there's a truce, how do you expect that would affect European defence spending? Do you still think that this commitment to an era of rearmament would be there? And how would that affect your business?
No, I mean, everything what we see at the moment is very sustainable. I think the budgets that are under consideration is a plan for the next decade to rearm Europe, and I think in Germany it's the same. I mean, looking at the Hensoldt business, our exposure is in a single low-digit percentage to Ukraine. And again, a peace in Ukraine, seize of weapons in Ukraine, will not erase the Russian threat. So that means clearly Europe has to continue on that path. And it would be a great risk if we stop those investments just for the sake of the ceasefire in Ukraine.
Oliver, the stock came into the beginning of this year at 35. We're now trading at 66. We've got a volatility interruption this morning. The stock has absolutely soared. Are you going to sell stock? Should you sell stock at this point to fund the enhancements that you need to make to the business? Very briefly.
Well, no, I think it's also premature to really look. As said, I think this all has to go through Parliament first. I think we're well prepared. As I've said, we have invested, we took the... So there's no need for quick capex and so on. So in this regards, we do our math now based on the decisions of the German Parliament. And then as we also discussed with the analysts, we will revisit our plans, our ambition, our guidance, I think in the second half of the year.
We'll look forward to that. Oliver, we're going to cut it short. Thank you very much indeed for joining us. Oliver Dorr joining us, the CEO of Hensoldt.
In case you missed it, from Bloomberg's coverage at Davos.
The issue of ending the war in Ukraine must be, I believe, the victory for Trump and not for Putin. Putin is nobody for him. America is way stronger and Europe is way stronger. China is way stronger than Russia. They are all players.
We are exploring ways for Argentina to be able to open up to international trade. And why? Because the division of labor brings prosperity. Adam Smith said so. And 250 years later, that holds true. Adam Smith is still right.
I would like taxes to be lower on people and on businesses, but I'm not going to play fast and loose with the public finances, because in the end, you actually don't result in anyone being better off, because it sends interest rates soaring.
I think everybody has welcomed the ceasefire in Gaza. but it's only first step. We hope that it will be a starting point for solving genuinely the Palestinian problem.
Nobody covers Davos like Bloomberg.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now. We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
The opening trade. We're 30 minutes into today's session, and European equities are powering ahead this morning, powered by the DAX, higher 3%, as you would expect, given this commitment from Germany to do whatever it takes when it comes to defence and Ukraine. Looking at some of those individual German defence names, and Rheinmetall up 2.7%, Hensoldt, we were just speaking to the CEO, up 6%, and Rent Group up 7.4% this morning. But I have to say, defence stocks are not the best performers this morning in terms of the sectoral basket. Construction and manufacturing actually doing even better. That's up 4% this morning. Perhaps some of these defence moves already priced in. But Germany's Chancellor in waiting, as I say, Friedrich Merz, explaining the need behind this move. Let's take a listen to that.
Deshalb wollen wir ein kreditfinanziertes.
I want to be very clear here. Whatever it takes must also go for our defense now, in view of the threats to our freedom and to peace on our continent.
For details, let's bring in Bloomberg Opinion's Chris Bryant out of Berlin. Chris, good to have you with us. When I saw this headline about 500 billion euros, it was a real shocking moment. I felt like we were in a new era. Just tell us how significant this really is.
Well, good morning. And yes, it does feel like a new era. If there were a couple of criticisms of Germany in the past, it was this: the economy is stagnating, the infrastructure was falling apart, and it didn't spend enough on its military. And now it's come out and said, you know, we're going to spend 500 billion to upgrade our infrastructure. And defense spending, essentially, there are no limits now. Anything above 1% of GDP will not be included in the debt brake, which means Germany is free to increase spending without coming at any cost to other types of spending, which gives it a lot more freedom. It's got plenty to do. It's only spending 2% of GDP at the moment, probably need to spend close to 3% in future, but it now has the fiscal wherewithal to do so.
Chris, how quickly does this happen? How quickly do the cogs start turning?
That's a very good question, and the answer is not as fast as we'd like, I think. Partly that's due to a lack of capacity, as we've heard before. Fortunately, though, this country is blessed with a huge manufacturing base, much of it, of course, geared towards the automotive industry. But, of course, the automotive industry now has a lot of spare capacity, potentially employees that can move into the defense sector. So I think now that this commitment is there, and it's very important that it comes in form of a debt brake and not another emergency fund, which wouldn't have given the defense companies the kind of long-term security they need to make those investments. Once this goes through Parliament, I think they'll have the confidence to invest, and you'll see an increase in capacity follow.
Okay, Chris, we'll leave it there. Thank you very much indeed. Chris Bryant from Bloomberg Opinion, talking about the significance of what we had coming out of Germany yesterday. We're certainly seeing some significance for the bond market this morning.
Yeah, certainly resonating through the bond markets this morning. Bunds for sure up by 17.9 basis points, 18 let's call it, on the German 10-year. But it's not stopping at Germany. We see those yields going higher across Europe, not to the same degree as Germany, but certainly everything in Europe seeing higher yields. And across the German curve, we see those higher yields. Let's get into this conversation then with Bloomberg's Valerie Teitel back on set with us. Valerie, give us your latest thoughts on the scale of this Bund move this morning, because it is across the curve and it is substantial.
Yeah, it is substantial. I mean, just look at the rest of the European bond market also suffering the same kind of declines. You know, France up 12 basis points, Italy up 11 basis points when it comes to their 10-year yields. But I think the thing that's surprising to me at the moment, given the market reaction, is just how positive the read-through is for European growth, is what the market is assuming right now. In some way, you can argue, or you can really pose a question to that conclusion, Anna, because Europe is just replacing free defense they used to get with the U.S. with one that they have to pay for. Is that really going to net create growth in the European Union? It seems like the market reaction, though, is very, very positive. I mean, I'm looking at the euro. We're flirting with 107. We just sustained a break about 105 just yesterday. There seems to be no doubt in the market's mind that this is going to some way turn around economic
But this is the
growth.
playbook from the United States. The United States, over the last few years, has run huge fiscal deficits, has basically powered its economy forward. Why can't Europe now have some of that as well? Why doesn't this translate into growth? Yeah, we are spending the money that we weren't spending before, and we're maybe having to spend money on defence that we didn't have to before. But Germany needs to rearm. That there's some trickle effect there, but the infrastructure story is also quite significant as well. This is the U.S. playbook, isn't it?
Well, in some way, the U.S., has the ability to do that because they are the reserve currency. Other nations need to start thinking about their fiscal headroom. Yes, Germany
doesn't have that problem.
Has ample room, but other nations, look at what the turmoil that France went through with their latest budget proposal. This might have to come alongside, at least for other countries, cuts to other areas.
But if Germany becomes an engine of growth again in Europe, again, the ripple effect into the rest of the continent is quite significant. You're not going to be just ordering from German companies. You're going to be ordering from French companies and Italian companies. There's plenty of ripple effect that could come out of Germany's fiscal story becoming easier and more growth oriented.
Yeah, so possibly driving more private investment into industrials on the back of it. But I would worry one thing, though, is that Trump in his speech overnight was really clamoring about these tax cuts. He needs to fund them in some way, and if he is cutting deals with Mexico and Canada, perhaps he is really looking to raise this tariff revenue against the European Union. So that could be one thing to the downside that we need to keep our eye on. If he does need to fund those tax cuts with tariffs, and he is cutting deals with other nations, perhaps the European Union is where he's setting his sights on raising that revenue.
Exactly. So where are you seeing euro dollar higher? 106 right now. How much is that also because of the dollar drop on tariffs? How much is it because of the dollar drop on Ukraine?
Look, I think a lot of the move in the euro is more about the growth differentials. Euro was very depressed, and many people were very depressed on the outlook for euro. Remember, we were calling for parity just a month ago due to the growth differentials between Europe and the U.S. That has totally done a 180. Now we're worried about the U.S. consumer, and we're not worried about the growth impact or about any negative growth impact in Europe. We're looking at revisions to the upside when it comes to European growth. So I think it's very much growth dynamics leading the currency moves, especially when it comes to the euro-dollar pair. But the ECB, could add a bit more to this. Will Lagarde sound positive tomorrow in this press conference, or will she in some way, urge caution in talking about the future of European growth because of these tariffs overhanging the European economy?
Lizzie's going to be there.
I know, cut now and then what? That's going to be the question for Christine Lagarde. And how do you factor in the defence story? Interesting to see Goldman, MUFG and TD abandoning the euro-dollar parity predictions already before we had this news on German defence. Bloomberg's Valerie Teitel, we thank you for that analysis. But that really setting us up for the ECB tomorrow.
It does set us up. You're going to be there, which is going to be really interesting. And the fiscal story versus the monetary story, I think, is absolutely fascinating. It's a story that the Fed is having to deal with as well. Valerie alluding to what is happening with the growth story, but the tariff story also inflationary. Let's talk about another aspect that has powered the US forward over the last few years, which could be changing. Donald Trump has called for an end to the $52 billion semiconductor subsidy program known as the CHIPS Act. Here's what he had to say in the address to Congress last night.
Your CHIPS Act is a horrible, horrible thing. We give hundreds of billions of dollars and it doesn't mean a thing. They take our money and they don't spend it. All that meant to them, we're giving them no money. All that was important to them was they didn't want to pay the tariffs, so they came and they're building, and many other companies are coming. We don't have to give them money.
The idea is that actually tariffs will encourage companies to come to the United States regardless. That's certainly an interesting aside to what has been talked about over the last few years in terms of the need for subsidies. Certainly Taiwan has driven that story. Bloomberg Intelligence senior analyst in this sector, Robert Lee, joins us now. Robert, what do you make of the comments? What happens now?
Okay, well, I guess it really ties in with what you were discussing about debt reduction a few moments ago with Elon Musk's efforts within Doge to try and reduce the level of government debt and maybe push the responsibility for funding some of these things onto third parties. So maybe there's a parallel in the same way that Trump is looking for European countries to carry more of the defense spending load, to protect the continent of Europe. Similarly, if TSMC and others are investing in the States, they should do that from their own balance sheets and not using US taxpayer money. So I think that's where he's coming from. But, what's it going to mean to the likes of TSMC?
Yeah, Rob, a lot of semiconductor factories are promised in Republican states. Surely this is going to be a hard sell in Congress. And I'm wondering what it means for those companies that have already been promised this subsidy support.
Yes, well, I guess the train is already in motion on the subsidy because TSMC's Arizona fab, going back to the Q4 earnings only a few weeks ago, they confirmed that that's in production at the moment, and actually the production yields are not too bad. So it's, an impossibility to reverse course on that. And as you would have seen earlier this week, TSMC confirmed plans to invest somewhere close to $100 billion in building out, I think, up to 6 fabs in the US, if you include the current one. So I would very much doubt that TSMC, et cetera, reverses course on this. And, going back to Trump's speech we saw a few minutes ago, he's sort of linking that with potential tariffs. So I guess there's been a reversal in US policy. Previously, there was very much using the carrot and incentives to attract investment into the US. Perhaps now they're using more of the stick. But from a company point of view, fabricating chips in places like the US, a developed country, a developed economy, does come with a cost penalty. So there's a question mark as to the long-term profit outlook within the US fabs of these overseas, mainly Asian companies investing in the States.
Okay, so from that then, do we conclude, Robert, that if they're using the stick is not going to prove as attractive as the carrot was, and therefore we don't see quite so much chip fabrication on US soil?
Well, that's a really tough one. I guess the direction of travel, I would say, still is pretty clear. The US is still the world's largest economy. Again, why is TSMC and others, putting plants in the US? Not just because they had the incentive or the US is in some way, coercing them to some degree. But, you've got some of the world's largest end customers, Apple in particular. So TSMC's new fab in Arizona will be servicing Apple. There is genuine business and genuine business reasons to be operating in the US. But long term, does that mean the profit margin at these US fabs is going to be lower than what they achieve in Asia? Then I think that's probably the case.
Yeah, planning for the long term certainly seems like a challenge right now. Bloomberg Intelligence senior analyst Robert Lee, thank you so much for joining us to talk about that chips story. 8:42 here in London. Coming up on the programme, we'll get back to the tariff story as it continues to develop out of Washington. US futures are higher on that theme. We'll get back to that shortly. We'll speak to the former Mexican Undersecretary of Finance and Public Credit. Washington's trade policy is a major topic of discussion at the ongoing Bloomberg Invest Summit in New York. We'll leave you with some of the highlights from our key guests.
I do factor in some effects of tariffs now on inflation, on prices.
We've not seen this level of tariff, at least in modern times.
I think these are going to adversely affect us with respect to inflation. They'll adversely affect us with respect to growth, adversely affect productivity.
The opinions on tariffs vary from they're incredibly inflationary to they are potentially contributing to a recession.
Gotta take that longer term approach. Hope or maybe expect at some point that they'll get to outcomes, markets will calm.
I think what you can't control
is consumer confidence and corporate confidence. And I think that is what is falling off a cliff right now.
What legacy I would love to leave is to make sure that in my village I have infrastructure. So long when I'm gone, things are still working, then I have done my job. And if some people get inspired through my work and then try to engage themselves for their community and create something that is inspiring for everyone, I will be happy.
What's the best piece of advice you would give to someone young who wants to make a difference actually in this world? In architecture or with something else?
Wow, I'm not the right one to just do that.
I think you are.
Yeah, but with the pressure you have, and then you try to be the good one, the fancy guy, the intellectual one, I have no advice than to believe in yourself and really work hard. You know, when I started, no one would have imagined that I will be able to see my name connected with Aga Khan or Pritzker or sitting in Bloomberg to talk about sustainability, about future of sales. No, myself 5 years ago, if you told me that, I will say no. I will never imagine. So I will encourage everyone to believe in what you're doing and not try to run after the newest of the newest. Just be consistent. Just work on things that matters for you. Really, at the long term, it pays.
Bloomberg brings you breaking news 24 hours a day, powered by 2,900 journalists and analysts in more than 150 offices across the globe. Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute financial and geopolitical news whenever and wherever it happens. I'm Francine Lacroix in Davos, Switzerland, and this is Bloomberg.
If you don't make your product in America, however, under the Trump administration, you will pay a tariff, and in some cases, a rather large one. Countless other nations charge us tremendously higher tariffs than we charge them. April 2nd, reciprocal tariffs kick in. The tariffs will go on agricultural product coming into America, and our farmers starting on April 2nd. It may be a little bit of an adjustment period. I have also imposed a 25% tariff on foreign aluminum, copper, lumber, and steel. Tariffs are about making America rich again and making America great again, and it's happening, and it will happen rather quickly. There'll be a little disturbance, but we're okay with that.
There'll be a little disturbance. President Trump there addressing the joint houses of Congress. Now, the Mexican president, Claudia Sheinbaum, is taking a diplomatic approach to negotiations with the United States to lift its 25% tariff. America's top trade partner may seek other markets for its exports if the tariffs continue.
But it is inconceivable that no thought is being given to the damage it will cause both U.S. citizens and U.S. companies as a result of the price increase of goods produced in our country, as well as the damage it will cause by putting a stop to job creation in both countries. Nobody wins in this decision. On the contrary, it affects the people we represent.
Joining us now is LSE Professor Vanessa Rubio Marquez, former Mexican Undersecretary of Finance and public credit. Really good to have you with us, Professor. Thanks for joining us. So we expect to hear from Mexico, I think, on Sunday about its retaliation. What are you expecting the substance of that to be, and why do you think Mexico is leaving it so long?
There's two moments in the future that I think we should consider. One that was also referred to by the president of Mexico yesterday in relation to the possibility of having a conversation with President Trump around Thursday. So this, I think it's a landmark that they expect that can change circumstances somehow, and that can hopefully reach to agreements. And then if that doesn't, result in a different outcome, then she was going to announce measures on Sunday. And she said that this could be tariff and non-tariff. So basically, I think what they're considering is to put also tariffs on specific products and on specific states in the United States.
Okay, we heard from the U.S. Commerce Secretary Howard Lutnick yesterday, and he was talking about the possibility of softening tariffs on Canada and Mexico as soon as today. If that indeed comes to pass, would that be a surprise?
Well, basically, none of this is a surprise anymore. Now, I think that we need to price in the lack of predictability and the lack of certainty that this new era we're in implies, and we need to navigate with this unpredictability and uncertainty. I think what Mexico wills to do is to strike a negotiation with the U.S. as we have done many occasions in the past, as it was done during presidency, the first presidency of President Trump, in which basically the constant threat was about the cancellation of back then NAFTA, also the anchor of the predictability of investment and trade in Mexico. Mexican exports to the U.S. represent 30% of our GDP. And as you were saying, we're the first trading partner of the United States, the first source of their imports, and also one of the main trading partners of the majority of the 50 states in the United States.
So we've talked about what the retaliation could be, but Vanessa, good morning. What about what Mexico could offer in terms of the border crossings? Because I'm looking at them and they're below 2019 levels. What more could Mexico be doing and offering to get this reprieve that Howard Lutnick is hinting at?
That's a key point, because if we see what is happening now, we're not negotiating trade with the United States. We're negotiating security in the form of the fight against cartels and against fentanyl, and in the other hand, migration. So basically, trade is being used as a tool for negotiation and as a threat in case not enough is being done on security and not enough is being done on migration. The question here on the table of negotiation is what is enough? And you need metrics for that, and you need to have numbers for that. In the first delay of 30 days of the imposition of these tariffs just a month ago, it was 10,000 troops of Mexican military in the border. What could be enough in terms of these tariffs being put to a halt for the next occasion? We don't know, and it's precisely what I think they're negotiating.
And if you were at that negotiating table, would you take comfort from the idea that there is a backstop on how far Donald Trump will go when it comes to tariffs, when it comes to inflation maybe, or growth, or the 10-year yield? What do you think that backstop is, if you see one?
I was in that table in Trump #1, being Deputy Minister of Finance of Mexico. And I can tell you that at the time we were negotiating a new version of NAFTA back then, we didn't know the name was going to be USMCA. We were still being threat about the canceling of NAFTA altogether. So it's a very tough time to be negotiating in that table. But you have to make agreements. You have to trust some of the elements of that negotiation. But again, I think there's something that here changed for good, which is the lack of predictability and the lack of certainty in doing business when we had 30 years of enjoying a framework and a predictable framework for doing business in North America. So that much is going to be done to growth, to inflation, to jobs, and to prosperity in the region.
Professor, good morning. It's Guy. Is Europe next?
anyone can be next in this war trade. I think anyone can be the target. We thought that being a partner of the United States, we thought that being the neighbor of the United States and being a trustworthy ally of the United States would mean that we would have this predictable framework for many years to come, no? But it's not the case. And what this implies is that all the agreements and all the legal frameworks are quite vulnerable to politics, to rhetoric, and I think anyone can go in this trade war. In the case of the EU, for instance, exports to the United States represent 3% of the GDP. In the case of Mexico, just as a matter of comparison, is 30%. So there's different levels of damage, but I think everybody will suffer, and of course jobs, and of course growth, and of course productivity will suffer, and companies and businesses need to price in this new ecosystem of volatility, of uncertainty, and this is not good for businesses, of course.
Do you think that we could end up in a spiral of tariffs? There was a suggestion yesterday that the United States may respond to Canada imposing reciprocal tariffs, that there may be reciprocity to the reciprocity. Is that, do you think, a road that we will go down, that ultimately we will end up in a spiral of tariffs, that this will get worse and worse? Or is it reasonably static once imposed? How should companies be thinking about this? How dynamic is the process going to be?
No, I think basically, since we're here on chartered waters, sky is the limit. If one imposes retaliatory measures and the other imposes reciprocal tariffs, and then retaliatory measures and then reciprocal tariffs, I mean, anything goes. But I think the fact that there's space for negotiation, space to halt this, is very important. To maintain dialogue is very important, to maintain a table of negotiation, because you cannot go with this ad infinitum. You would basically target growth, target prosperity, target poverty, target jobs, and this is not the end game. In the case of Mexico, basically it has been clear that the end game is actions on security and actions on migration. Well, let's discuss migration, let's discuss security, and then of course discuss trade to have a predictable framework once again.
Predictable, that's a key word right now. LSE professor in the practice, Vanessa Rubio Marquez, thank you very much indeed. Coming up later today, maybe we'll get some news. U.S. Commerce Secretary Howard Lutnick will be live on Bloomberg Surveillance. That conversation, 1 p.m. GMT, 8 a.m. Eastern Time. Let's talk about the markets very quickly.
Yeah, US futures are watching that Lutnick conversation, watched it yesterday. I'll just draw our attention, there's so much to handle this morning, to a headline across the Bloomberg terminal saying that the EU is delaying its roadmap to phase out Russian gas. Now, Europe relies a lot less on Russian gas than it did, but there's still some reliance. This feels like more shifting of the tectonic geopolitical plates as Russia comes in from the cold, certainly from a US perspective. What does this mean for Europe?
Europe desperately needs cheaper energy. That is certainly a story, making it more competitive, but at what cost? And maybe actually you've got to think about the defence spending that is being now proposed as well, and think about that in that context too.
Which indeed is powering the euro higher. As Valerie said, we're flirting with a 107 handle at this point, stronger 0.7% as traders consider how much economic growth could come off this defence spending. That does it for the opening trade. The pulse is up next. This is Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Asia is at the forefront of some of the world's biggest stories. I'm Chevrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern. Only on Bloomberg. Context changes everything.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
President Trump admits tariffs will cause disruption as he doubles down on his trade policy. European stocks climb, bonds tumble on Germany's plans to unleash hundreds of billions of euros for defense and infrastructure. Plus, China pledges to support domestic demand in the face of U.S. tariffs, setting a bullish target for growth and lifting borrowing to the highest level in more than 30 years. Now, there is a lot going on. We have a packed show, but first thing is first, let's also look at the European markets map. Now, it's very clear that European stocks are actually climbing in today's trading session. Bonds in the region tumbling on Germany's plan to unleash hundreds of billions of euros for defense and infrastructure. So that's giving a little bit of buoyancy out there from risk takers for the markets. The CAC 40, 1.6% higher. The DAX, definitely the outlier because it's gaining by so much more than some of these other indices, gaining 2.5%. But if you look at the composition of these indices, it's probably the ones that are more skewed towards defense that are lifting the higher. Now, markets also recalibrating not only around Germany's decision to amend its constitution to exempt defense and security outlays for limits on fiscal spending, but a lot of the focus is on tariffs with the U.S. There's a couple of notes out there also on what the U.S. intends to do with dollar going forward. So I would look at euro dollar 107.03. Very clearly, the German story is left, right, and center, and then the U.S. 10-year yield at 4.2269. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, President Donald Trump's 100-minute address to Congress, Germany's plan to unleash billions of euros for defense, and China's ambitious growth target are the big stories that we're covering this morning. Now, in just a moment, we'll be live in Beijing with Bloomberg's Min Lo. We'll also discuss the latest from Washington and Europe with Bloomberg's EMEA news director, Rosalind Matheson. We'll unpack the market moves with Natalia Lipikina, head of EMEA equity strategy at JP Morgan Private Bank, who's here in the studio as well. But of course, let's start with Donald Trump and President Trump defending his use of tariffs to remake the U.S. economy. Now, he's shrugged off concerns by saying there would be, quote, an adjustment period as the measures take effect.
Tariffs are about making America rich again and making America great again, and it's happening, and it will happen rather quickly. There'll be a little disturbance, but we're okay with that.
So let's start with Donald Trump. Roz, there was a lot in that speech, okay? I mean, most of us listened to it, if not during the night this morning, and it was foreign policy, there was economics. Do we have a much clearer picture on how aggressive Trump's administration wants to be?
Well, certainly we got the message that he thinks that tariffs are the right thing to do, and he's using those both as a political tool and as an economic lever. Equally, you know, he does do deals, and we're hearing already again from his Commerce Secretary that he might lower some of the tariff rates on Canada and Mexico straight after implementing them. But he did talk a lot about reciprocal tariffs, his desire to push ahead with that, and really for him, interestingly, a bit of an acknowledgement that tariffs are going to cause some disruption to the US economy. It was striking in a way. He didn't dwell on the economy too much in his speech because that perhaps is his weak point. And the message to Americans was this is overarchingly a good thing. He started to skate it over a little bit, the potential impact on inflation and growth, because that's again where he's possibly a bit vulnerable. But he did acknowledge there is going to be some disruption to the US economy from tariffs. It's not just all a win-win, but he described that obviously as relatively small. But certainly you can see from that, you know, he feels again that tariffs are having an impact already.
Yeah, and I wonder whether it's tariffs for the sake of tariffs because he then stops goods coming in, or whether there's a manufacturing base that he can bring back home. I was surprised to hear him talk about, you know, Greenland with such fighting words, with also Congress laughing when he said, you know, it'll be ours one way or another.
It was interesting, again, he ran through some of these, you know, Panama, Greenland as well, having digs at Canada. But this is all part of how he sees America first. In a way, it's both economic and it's also about security. So he sees, you know, having security of supply, be it around critical minerals, for example, which is why he seems to be fixated on Greenland. But also he sees Greenland as being part of American security because it's not that far from the US coast, and he sees it as part of the geostrategic element, which is, again, he's talking about how can the US get what it needs from Greenland without potentially taking control of Greenland. There's all sorts of things there in terms of what he means by control, but certainly he sees it as those two elements, you know, control of resources, control of supply, bringing back resilience and self-reliance to the US economy, but also about security in the proximity to the US.
Ross, I want to ask you about Russia in a second, but Natalia, good morning. Overall, I mean, yesterday we saw a big sell-off as the tariffs took place, so the Trump rally that we saw kind of faded off. Where are we today?
Well, there is still a lot of uncertainty with regards to tariffs. We still don't know how big they will be. We don't know what is the timeline. Are they going to be temporary or not? We are the long-term investors. For us, what matters is earnings. Of course, the market doesn't like uncertainty, and tariffs most likely will continue to be a bit of an overhang risk. But if we're looking into the earnings growth in the United States, for example, we actually see double-digit growth in 2025 and 2026. So for us, we are buyers of the dip at this point.
Yeah, and I guess the impact of these policies will depend, of course, on the magnitude and the duration, as you say. Is Europe the automatic loser in this? We'll talk about Germany in a second, but it feels if it's America first, then there has to be a loser.
Well, if we're looking into what is happening in Europe right now, we do have a stimulus boost coming from Germany this morning. And when we're looking into, you know, what is moving the market is actually industrials that were one of the worst performing sectors yesterday. So there is a bit of offset with that. And for us, for example, industrials does continue to be a sector where we continue to focus on.
Let's also talk about China. Natalia Lipikina from JP Morgan and Ross Matheson stay with us. But to China, which has once again set its economic growth goal for this year at about 5% at the National People's Congress in Beijing. Now also targeting a fiscal deficit around 4% of GDP, the highest in 3 decades, and a sign of stimulus spending to come. Min Min Lo, Bloomberg's China correspondent, joins us now from Beijing. So Min Min, will China achieve the ambitious target of 5% growth this year?
Well, 5% is quite ambitious, given that it's the same target that they set last year, which they managed to hit by the end of the year, but that was without a trade war going on. So the external environment this year is much more challenging. The consensus forecast for China's growth is 4.5%. So to get to 5%, they will need to unleash a significant amount of stimulus. But the government's intention is clear because you look at the deficit target, 4%, the highest since 1994. The quota for bond issuance from the local government and central government both being raised as well. And this is important because it will enhance the local government's ability to pay back salaries to civil servants and money owed to enterprises. Some analysts saying that maybe the fiscal budget still is not enough to meet that ambitious growth target, but bear in mind China could still revise that budget mid-year as well. They could be keeping their cards close for now while they assess the final impact of tariffs. But what really stood out to me in this government work report is the government priority this year. The number one task listed in the work report is to boost domestic spending, domestic consumption, as opposed to supporting those new quality productive forces. That was the first government priority last year. It's now relegated to number 2. So it's clear that the government is now focusing on getting people to spend, and to that end they have listed that they were going to promote income growth, promote social services, raising things like pension and medical benefits by 20 to 30 yuan for rural residents. Bear in mind though, that's very meager numbers, just $2 to $4. So to what extent is that really going to cause people to lower their precautionary savings? That's still a big question. So a lot of details yet to be sketched out. They will be in the next weeks and months, and the details is going to be how in the implementation of this and how local governments are going to implement the directives from the top echelons of the Communist Party.
Min, thank you so much for the terrific briefing. Min Lo, Bloomberg's China correspondent in Beijing. I know there's also some great reporting from Bloomberg. One of my favorite pieces was over the weekend. It was an essay by Dan Tenkate saying it's Xi Jinping's world and Trump is just living in it. Now, President Trump has also called for ending a bipartisan $52 billion semiconductor subsidy program that spurred more than $400 billion in investments from companies like TSMC and Intel. And you can see on the back of that pre-market, they're actually still holding up to gains. The side of the subsidy program gaining some 3%. Coming up, Germany abandons its fiscal shackles in a dramatic shift to transform Europe's defenses. We'll discuss the significance of the move next. This is Bloomberg.
Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Now, Europe's biggest economy is taking a major step to bolster its defense capabilities. Germany is amending its constitution to exempt defense and security outlays from limits on fiscal spending. Now, the Chancellor in waiting, Friedrich Merz, explained the need behind the move.
Deshalb wollen wir ein kreditfinanziertes
I want to be very clear here. Whatever it takes must also go for our defense now, in view of the threats to our freedom and to peace on our continent.
We're back with Rosalind Matheson, our EMEA News Director, and Natalia Lipikina, Head of EMEA Equity Strategy at JP Morgan Private Bank. Ros, I mean, this feels like a whatever-it-takes moment for Germany.
Well, that's right. I mean, extraordinary moves by Friedrich Merz before he's even Chancellor. There's been a lot of talk about how long it takes to get coalition governments formed in Germany, weeks, sometimes months, and the idea that Olaf Scholz was there as a caretaker only, really in that bridging period. But he's out of the gate really fast. He's not even in the chair. And extraordinary to show already that he's bridging the gap, you know, that gulf with Olaf Scholz's party to say, let's work together on this. And it's actually just really important for Germany to crack on and get this done. I mean, obviously there are potential hurdles to getting the constitution changed. It's got to go through Parliament. You may need other parties to do so. There may be legal challenges, but a really strong signal from Friedrich Merz about where his thinking is. He's breaking, pardon the pun, with, you know, years of understood fiscal behaviour in Germany. I mean, this debt break that we're talking about survived the pandemic, it survived other crises, and yet Donald Trump has now broken that break effectively for Germany, in a sign of just how serious Germany sees the moment that we're in and the need to really revamp their economy in terms of spending on infrastructure. You can see the reaction in the market on that front today, and really helping take the lead on defence, because Germany, of all the countries in Europe, does have the fiscal room to do this.
And Natalia, how much of a game changer is this really for European growth, but also Germany seems back in full force?
Yeah, I would say that for us it's very reassuring to see that the sector moves this morning. We're seeing the industrial sector moving the most, and this is the sector that we have been quite positive on, and this is just an additional layer of positivity, if you will, for that sector. There are loads of different secular growth that the sector is currently facing, and infrastructure spend is just another additional one that is probably going to be very positive for years to come. Yes, the infrastructure spend is important, but so is data centers and electrification. So overall, this is the sector that will continue to benefit from it.
I mean, it brings me back to that Draghi report. I think that the Germans kind of, you know, within an hour said thank you, but no thank you, in terms of the kind of money that needed to be invested in Europe. Is this, you know, closer to that number? Again, we're going through the back of the envelope to say exactly how much this is, and will it spur other countries to do similar moves in defense?
I think it's definitely a step in the right direction. I think this is addressing those weaknesses that the European economy has been facing, and it's very reassuring to see how a European market is actually reporting and today.
Ros, I mean, on the geopolitics front, there's something that, you know, Bloomberg broke yesterday that basically said in that call that we don't really know what kind of agreements were done between Donald Trump and Vladimir Putin. Putin also offered help with dealing with Iran and you know, some of the nuclear accords. Does that explain the U-turn from the U.S. on Ukraine?
Well, it just shows how fast things are moving, and again explains a bit the German decision, perhaps, because you can't sit and wait at the moment. But what's very clear from that, and whether it was Donald Trump asked Vladimir Putin or Vladimir Putin offered, it's clear they're talking about a whole range of things in a reset of the relationship between the US and Russia, and ways that they can essentially work together or give each other help here and you help me there and we'll do this as a trade-off. And it just shows the depth of that conversation. And we know there's a lot of back-channeling going on between the US and Russia, also public-facing talks between officials, and it's a really broad reset. We're talking about reopening embassies potentially on the table. That's been part of the conversation, and now facilitating a role for Vladimir Putin in Iran, because Iran would be very happy to talk to the US. And if Putin can facilitate that, you know, that's going to be a positive potentially for Iran also. So you've got Donald Trump potentially positioning Putin as a negotiator in a way with the US on Iran. So the relationship between Vladimir Putin and Donald Trump is changing very quickly. What that means for Ukraine, again, is the question. We didn't get overnight the signing of the minerals deal between the US and Ukraine. There'd been some expectation that might now move forward, but either way in those negotiations, it's very clear that Donald Trump is talking to Vladimir Putin, does have his ear, and that's got to be a concern for Ukraine.
All right, thank you both for joining us. Natalia Lipikina from JP Morgan Private Bank and Bloomberg's Rosalind Matheson. Coming up, Sandoz rallies as a Swiss pharma company sees sales continuing to grow. We speak to the chief executive next, and this is Bloomberg.
bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Shares rallying in Sandoz after the Swiss maker of generic medicine said sales growth will be powered by profitable new biosimilar drugs, cheaper versions of complex medicines produced from living organisms. Overall, the company reported earnings in line with analyst estimates for last year. Well, joining us now is Richard Saynor, Chief Executive of Sandoz. Richard, thank you for joining us. Your share price is gaining 6%, so I'm sure you're having an okay day. The guidance, was pretty impactful in terms of potential things that could benefit. But how worried are you about tariffs, especially tariffs against pharmaceutical companies?
No, look, and thank you so much for the question, and it's a pleasure to be here. Let's take a step back. First and foremost, more than 80% of our revenues for the company are ex-US, so we're clearly a very strong European business, have a big international business, and a strong Canadian business. So the less than 20% that is exposed to the US. But then again, pretty much all of the generics and biosimilars that American patients are taking today are either manufactured in the US but using drug substance coming from Asia, or predominantly actually manufactured from outside the US. So I think you're going to see a number of effects. First and foremost, in the short term, I think it'll drive even more patient access and instability in terms of supply. In the medium term, ultimately, pricing will get passed on through payers and ultimately to insurers and ultimately to patients. Right. So I don't think this is in the interests of patients or healthcare generally in the US. Again, then the question is, okay, well, is it worth investing in the US to fundamentally change that? Until we see a fundamental change in the PBMs and the GPOs, really the main purchasing bodies in the US, there's little point. The amount of government business is actually very small in the US, and so it really doesn't still make it an attractive place to make large capital investments that's going to take many years to access. So I think it's an industry-wide effect. Every morning I get up, it seems to be changing, so we will see.
Okay, Richard, if we just unpack that a little bit, would tariffs on pharmaceuticals, for example, affect the price and availability of your drugs, the Sandoz drugs in the U.S.?
I mean, certainly, I think pricing will get passed on through to the payers in the medium term, not necessarily immediately. But again, what it will do is, I guess, the U.S. is probably the worst supplied market in terms of security of supply, because particularly small generics are being sold at pennies on the dollar. The PBMs and the GPOs make a significant profit on that, but actually the manufacturers make very little profit. So all this will do will drive greater instability and greater lack of security of supply. So I think we'll see what happens. The AAM, which is the American Association of Medicines, our president of the U.S. business, Karen Haruvi, is actually chairwoman of that, was in the White House on Friday, having these conversations with the administration, really to think about, ultimately, we want the same thing. We want to drive access for patients at an affordable price in a sustainable way. So ultimately, I think we want the same things. We just need to find the mechanisms to do that.
But Richard, do you see an increase in production or actually a change in production strategy or your markets that you target because of pressure from the U.S.?
No. U.S. is still an attractive market. It's still the largest pharmaceutical market in the world, particularly on the biosimilar side. I think we're launching at least 3 biosimilars in the U.S. This year. We're currently ranked number 3 in the U.S. as a biosimilar company. We have an aspiration to become number 1 ex-U.S. We're the largest biosimilar company in the world. We're a very strong player in Europe and the rest of the international regions, and we have a record number of launches and probably the deepest and broadest pipeline in the industry. So, I think we're extremely well paced with the scale and the capability to continue to leverage. And then when you take another step back, there's $400 billion of product coming off patent in the next 10 years. That's more product coming off patent in the next 10 years than has come off in the history of this industry. And Sandoz, as the largest and strongest player, I think is uniquely positioned to capture significant value here.
Yeah, Richard, I mean, as you were saying, I think our Bloomberg intelligence experts told me there are about $140 billion in revenue lost to patent protection by 2030. So where do you see the most opportunities? What are you most excited about?
Everywhere you look, I mean, clearly, most conversations I talk about GLP-1s, so clearly we see those starting to come off. I mean, semaglutide, actually, the patent, there's no patent actually, but the data exclusivity in Canada expires next year. Then we see that rolling out into the international market. There's a significant number of biologic products coming off patent. We see opportunities there, and a broad space of other more classic generic small molecules. So there's a significant amount of value, as I said, more coming off patent than in the history of the industry has actually come off in the past. So I think very optimistic about the opportunities to create value.
Thank you so much. Richard Saynor there, the Chief Executive of Sandoz. Coming up, we discuss the deal environment and how private capital is navigating the tariff uncertainty with Kurt Björklund, the Executive Chairman of Permira. That's next, and this is Bloomberg.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
It's just because we're behind the scenes, but it's big, with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onin, only on Bloomberg. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. President Trump admits tariffs will cause disruption as he doubles down on his trade policy. European stocks climb, bonds tumble on Germany's plans to unleash hundreds of billions of euros for defense and infrastructure. Plus, China pledges to support domestic demand in the face of U.S. tariffs, setting a bullish target for growth and lifting borrowing to the highest level in more than 30 years. So deal makers are hoping to put some relatively mediocre years behind them with big expectations for 2025. Traders are expecting a lower rate environment over the coming year, but the private capital industry is still facing a lot of headwinds, including macro volatility and global trade tension. Well, let's discuss all of this with Kurt Bjorkund, who recently moved from sole managing partner to executive chairman at Permira, with the company announcing its first major leadership change in 16 years. Now, the London-based firm manages around 80 billion euros across private credit and equity, ranging from technology to healthcare and climate. So, Kurt, thank you so much for joining us. Look, there's a lot going on in terms of the state of the world in 2025, and I think there was a lot of hope from private markets, but also public markets, that 2025 was going to be a better year, a more stable year. Are you concerned about the state of the exit environment, given the first couple of weeks?
Well, first of all, thank you for having me on this morning. I think this year is going to be marked by extreme volatility. We've seen that over the last couple of months. It's going to continue. I'm not sure that that's the right environment to look for stable deal making in. I would say that in 22 and 23, we had record years of deployment. So when the markets are really weak, that's when the opportunities emerge for private equity. And it's easy to forget that our job is to look for good value when there's less capital chasing those good opportunities. And then in 24, when the market environment got a bit more stable, we were net sellers across our portfolio. So we realized we exited a lot of companies. And this year, I mean, who knows? We have a lot of capital to deploy. We are looking for interesting opportunities. We are micro asset selectors, and we govern companies. We have a portfolio where we have double-digit revenue growth, high teens EBITDA growth, and with that sort of profile, even in this kind of environment, we can find great opportunities to invest in.
Kurt, what does that mean? How are you navigating this, macro volatility, or where do you think the opportunities will lie?
We own companies on average 5, 6, 7 years, right? So we look for long-term thematic opportunities that emerge in any environment. And as long as the operating profits grow in the portfolio, we're kind of fine with what the market does. And I think that's very, very different from an equity investor in the public markets, where you really have to position offensively or defensively, depending on what the market macro does from month to month. So for us, we kind of look at this. We always see opportunity and volatility. And then when we can exit, we exit full tilt. And when we cannot exit and there's a good buying opportunity, we deploy and we invest. So in this kind of environment, we see tremendous opportunity in the volatility, in the opportunities that emerge from people looking for liquidity, corporates looking to sell parts of them, other financial owners looking to realize their holdings. And we look at probably 100 or 200 companies every year, and out of that comes a handful or 2 handfuls of great opportunities that we invest in.
Kurt, I mean, and I know that, no matter how you slice it, I guess tariffs are messy, especially as you don't really know where it goes. Is it impacting your current portfolio? So companies that you've bought where you hadn't planned for tariffs to be so aggressive or come so quickly?
So we are lucky in the sense that we have a relatively small share of companies that are actually subject to the tariffs, right? So where you move physical goods around and are subject to tariffs. I think that we're going to see what actually happens and where this lands, because there's a lot of, shall I say, positioning going on, and the mind seems to change. There's a negotiation agenda that is happening, and where this lands in 6 months' time, I don't know. But what is very clear to me is that in the US, you have strong inflationary forces at work, and that will lead to rates being higher rather than lower, which then will lead to liquidity over time coming out. It will lead to both equity and bond market valuations being under pressure, whereas in Europe, you have disinflationary forces. I mean, let's see with this announcement from Germany this morning, but it is likely that we'll see a significant divergence of the rate environment in Europe versus the US. And when we look at that, we say, okay, so you get this impetus, this stimulus coming into Europe at the moment. You will have a lower rate environment. Valuations are order of magnitude lower in Europe. So maybe there's a great opportunity. We are transatlantic, right? So we are kind of half and half, North America and Europe. So we can pick and choose. We can build our portfolio where we see the best opportunities.
Like it's like an optimist guide to the markets. Are you expecting further consolidation in your industry, in private capital industry, but particularly in credit?
We have seen significant consolidation in private credit, and I think that's a segment of our industry where scale really matters. We've been growing to significant scale in Europe. If you look at what some of especially the North American players are doing, scale is growing rapidly. So yeah, over time, I think the market shares will continue increasing of the leaders in that space.
How much? I mean, is bigger better because you face actually headwinds? You know, is it the ones? It feels like the big ones are doing great. The small ones are trying to figure out, but it's really the middle that's getting squeezed.
I think. So any alternative asset investing is about whether you can create alpha or not. Yeah. That's fundamentally it. So in our private equity segment, we are one of the clear market leaders in that. We are a private firm. It makes our life very simple. We serve only one objective, which is financial returns through investing in great long-term growth compounders. That's what we do. In the private credit business, we look for opportunities where it's not about the mass, the huge scale of the sort of liquid credit investing, where you just need to have hundreds and hundreds of billions in scale to deliver good results because your margin is squeezed. So instead, we focus on direct lending in Europe, which is less competitive, especially in the middle market. We focus on European CLOs. We're growing that CLO business, which is a top decile performer, into North America as well. So we see opportunities in a very disciplined, alpha-focused credit investor of our scale.
Kurt, when you look at defense, it's, of course, a very big focus in Europe right now. Do you see specific opportunities for investment there?
So we have not traditionally invested as a firm in defense, but I think that the theme of investing in defense or defense-enabling technologies will become very attractive and very significant in Europe as we go forward. Just simply by unplugging the U.S. implicit security guarantee, if you will, or at least creating sufficient uncertainty over that will cause Europeans, as we are seeing now, just pour in with hundreds and hundreds of billions of dollars into that segment. It is the right thing to do, by the way. It's overdue, but opportunities will come from that too.
Kurt, we're just getting actually some breaking news from the Financial Conduct Authority, warning that valuations in private markets can be affected by conflicts of interest, poor record keeping, smoothing, and volatility. So they're saying they're worried about this. It just broke, so I don't want to be unfair. It's not mentioning any specific companies, but do you have concerns? Do you feel you're being given a hard time by regulators in general just because of the space you sit in?
The FCA is doing its job, right? So the private markets are opaque, just by definition, right? So there's a private portfolio. It is our job to responsibly and in a way which is aligned with our investors, value it and to govern it, and then to report it to our investors. And we do so. We do so to the best of our abilities. We do it responsibly and we do it right. Now, the FCA, again, is doing its job because it is looking at an industry where there would be scope, if more so than in public market investing, where it's pretty clear. You can look at the terminal and you can see what the stock price is. So I don't have any concerns about that.
Kurt, thank you so much for joining us. That was Kurt Björklund, the Executive Chairman of Permira. Now, coming up as Emirates announces new routes, we'll discuss the outlook for the aviation industry in the midst of rising trade tensions. We speak to the airline's president next, and this is Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people,
the tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Emirates is set to expand operations in Asia with 3 new air routes to China, Cambodia, and Vietnam. But with escalating U.S. tariffs and continuing economic uncertainty, what's the outlook for the aviation sector? Now, for more, let's go straight to our airlines expert, Guy Johnson, who's speaking to the Emirates president. Hi, Guy.
Hi, Francine. Yes, that, of course, is Sir Tim Clark, who joins us from Berlin. Sir Tim, great to have you on the programme. Thanks for taking the time to join us this morning. Francine, just talking about the more fragmented world that we appear to be moving into. You run one of the world's biggest and most global airlines. What does a more fragmented world mean to Emirates?
Well, I think we're with the announcements of these tariff arrangements between Canada, Mexico, and possibly even Europe going forward, we're in uncharted territory, Guy. One can see inflationary pressures coming in as a result. We can see that affecting discretionary incomes with regard to how they impact demand for air travel. But I'm not saying that we've been here before, but this airline has been used to sort of global traumas of some status, if you like, over the last 15 or 20 years, more actually. So we'll have to navigate our way through it. The demand for our services in the next 6 months or a year are very strong, irrespective of this. But which way this goes, it's uncharted. So we'll just have to wait and see.
You've, in the past, proved to be very flexible and adapted the network very quickly to take advantage, you could argue, of some of the disruptions that we've seen. But President Trump last night warning of economic discomfort. You talk about the fact that demand is holding up at the moment. What does economic discomfort, do you think, mean?
Well, I think as far as the airline is concerned, it means that the decisions taken for travel may be compromised, reduced, the scale of which I'm not altogether sure at the moment. My own view is that this will resolve itself. There will be, over the next 6 months, a year, a reset. I think the level of tariff will possibly fall depending on which countries enter into some kind of transactional arrangement with the United States. I think this is just the beginning of a period of uncertainty. As the president says, economic discomfort. Will it last forever? No, I don't believe that for a moment. The global economy is in a little bit of a fragile state at the moment, but you know there are a lot of things going on which will survive this what could be a tariff war, and I remain optimistic that certainly we can work our way around all of these particular issues going forward.
In other news, Sir Tim, overnight, China setting a pretty bullish economic forecast, talking about 5% growth. I think last year you picked up 14 extra routes into China. The talk is that you're going to get another 14 this year. That will take you to what, circa 91 in terms of the flights you're able to offer. Is that your expectation? Would you expect to pick up the same number of routes that you picked up last year this year?
I think the Chinese government has been very accommodating. They want to see business moving between China, certainly the UAE and beyond. And I think, to the point I was saying earlier, it's at the moment there are other things going on in the economy other than tariff wars, and some countries are minded to expand their GDP. China is one of those. With the expansion of GDP will come for demand for air travel, and therefore we would, you're right, we have got further access into China. We'll be pushing more in there beyond the point we just added in the last week or so, starting in July. It's a great market. It's a very buoyant market. It's a well sought after market. So we will go there and continue to expand our operations there. It's a great market for us.
Would you anticipate the same sort of pickup that we saw last year, though, in terms of the access that you are granted? Is that the trajectory we're on in terms of opening that market up?
We are constrained by aircraft availability, of course, and as you know, the story with the 777X is known to all. So long as we are constrained, we can't do as much as we would like to do now. But as soon as we get these aeroplanes, we'll be moving into the Asian theatre more than we are perhaps today.
Okay, let's talk about the availability of aircraft. You bring it up, Tim. Europe has announced a big defence package. Airbus is already struggling with a supply chain that is partly as a result of labour, partly as a result of parts. If Europe focuses on defence spending, do you think that'll make Airbus's challenges even greater?
Well, I obviously this is something completely new. So yes, if you're going to spend hundreds of billions on defence, using the same suppliers into the civil aerospace industry, there's going to be difficulties. I would, if I was one of those suppliers, I'd be looking very seriously about expanding my capabilities, creating new plant, and responding very quickly to that. But I tend to find with a lot of European manufacturers, there's a high degree of conservatism. And therefore, this could be an issue that faces the European aerospace industry if this goes ahead. There's plenty of room and opportunity for everybody to get their act together and supply both. But if they tend to prioritise defence before aerospace, then there could be issues for the whole of the supply chain, not just in Europe but elsewhere. So hopefully that's not going to happen.
So, Tim, the Dubai Air Show is later this year, so that's kind of the North Star in our compass as we look forward to try and understand what you are going to be delivering in terms of orders. There's all kinds of challenges at the moment. You've got an A350-1000 that's got a Rolls-Royce engine story that you are not happy with at the moment. Does that take the A350-1000 off the table? Does it make it more likely that when Kelly Ortberg comes and visits you in a few weeks' time, that potentially you could be talking about a 787 order or continuing with the 787 order? What are you thinking about at the moment in terms of the orders that you are potentially going to be making? Any aircraft that stand out at the moment? Anything that we should look forward to in Dubai later this year?
Well, you're right. We are likely, or we have 210 777s on order at the moment. We would obviously be ordering more of those in the fullness of time, simply because our network is expanding, and is obviously the aircraft that we got heavily involved in the design of which back in 2010. So what happens at the air show? Yes, we're looking at additional fleet. Bearing in mind that we are looking now into the mid-30s, simply because the manufacturers are not in a position really to offer many new aircraft to any client before the turn of this decade. So you need to look at locking in positions for both Boeing and Airbus, given the ability to meet the current backlog and get that sorted out. So the air show will give us an opportunity, probably the timing, to order some more aircraft. I can't actually say which ones they are. You've named a few of them. But basically, we're in the market for the 350s. We're in the market for the 777s. Unfortunately, we're not in the market for the 380 yet.
No. The 380, well, you're just refurbishing as many of those as you possibly can at the moment. Tim, it's great to catch up. Thank you very much indeed for your time today in Berlin. Sir Tim Clark, the Emirates President, thank you very much indeed. Francine.
What a great interview. Guy Johnson learned a lot, of course, on the way forward for aerospace. Coming up, President Trump says the U.S. CHIPS Act is a horrible thing, despite the $52 billion program receiving a bipartisan support less than 3 years ago. That's next, and this is Bloomberg.
your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
Bloomberg brings you breaking news 24 hours a day, powered by 2,900 journalists and analysts in more than 150 offices across the globe. Bloomberg Television. Context changes everything.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Donald Trump has called for an end to the $52 billion semiconductor subsidy program known as the CHIP Act. Now, here's what he had to say about it during his address to Congress overnight.
Your CHIPS Act is a horrible, horrible thing. We give hundreds of billions of dollars, and it doesn't mean a thing. They take our money and they don't spend it. All that meant to them, we're giving them no money. All that was important to them was they didn't want to pay the tariffs, so they came and they're building, and many other companies are coming. We don't have to give them money.
Now, for more, we're joined by Bloomberg Intelligence senior analyst Robert Lee. Robert, thank you for joining us. So what has prompted Trump's comments?
I think this ties in with the general moves within the U.S. administration to reduce both the deficit and the level of underlying debt. So maybe we can draw a parallel here with what Trump is trying to do with European defense spending, forcing or encouraging European countries to take more of the burden on themselves. Similarly, if you draw a parallel with the chip side, if foreign companies, predominantly Asian countries or companies are investing in the US, then they should be funding that themselves, not at the expense of the US taxpayer. So I think that's the underlying logic. And probably, again, taking a step back, what we saw with the previous administration, there was very much a carrot and not a stick approach. Incentivization, grants and subsidies were offered to encourage TSMC and its peers to invest in the States. Trump is taking a different approach, a bit more of the stick. Whether you want to call it coercion or whatever, there is a sort of veiled a mention of tariffs in what he said in the video clip you played. So I think, there are still many good underlying business reasons why Asian chip companies should be expanding into the US. The US is still home to many of the world's largest equipment companies, Apple being a prime example. However, operating in a developed country like the US comes with a cost penalty. So without those subsidies, there's a question mark as to the impact on the long-term profit outlook in US businesses of TSMC and its peers.
So, I mean, again, the future of chip-making fabrication on U.S. soil, I guess, is put into question, Robert. But at the same time, it's not as easy for Donald Trump to dismantle this.
No, I guess the train has left the station there because TSMC at its recent Q4 results confirmed that its Arizona fab is up and running, and it's actually producing chips at good yield for Apple. And you may have remember only a few days ago, TSMC confirmed it was going to build, I think, a total of 6 fabs, including this aforementioned Arizona fab, spending about $100 billion US in capex. So I'd very much doubt we see a reversal, but I think the real question mark is the potential negative impact on the profitability of these companies, if subsidies are in question or subsidies, in fact, are being taken away. So, but again, Trump needs to do what he needs to do to manage and handle the US deficit situation.
Thank you so much. As always, Bloomberg Intelligence Senior Analyst Robert Lee. Now, don't miss our interview with the U.S. Commerce Secretary Howard Lutnick. That's on Bloomberg Surveillance. It's coming up at 1 p.m. London time, 8 a.m. in New York. Up next, a Bloomberg Brief, Danny Berger and Manus Cranny in New York. This is Bloomberg.
biggest risk in property and casualty, is that now climate change?
Yes.
Climate change?
Yeah, so absolutely. When you look at natural catastrophes, the number of events has significantly increased, and not only the very big events like hurricanes, but also what we call secondary perils, so wildfires, floodings, and drought. And this leads to the fact that you have far more events and therefore a much higher cost of all of the natural catastrophes.
How do you really assess the risk of climate change? Because how can you possibly know whether there's going to be a hurricane or a flood? Is it just based on the past or the projection of the future? Or what? How do you do that?
Since the dynamic has changed, we need to also look forward. And what we do a lot, we work a lot with scientists who understand what the warming of the Earth and climate change will mean for the question of taking risk. And secondly, we take much less risk than we used to take because we have to be careful.
So let's suppose there are a lot of hurricanes. Is that good for property and casualty insurers or not? Good because people say, well, there's going to be more hurricanes, I should buy more insurance, or not good because you got to pay a lot of claims?
It depends. I would say it's good because it creates the awareness to do more prevention. What we see today is that, as I said earlier, there is more events. It becomes more and more difficult to insure, and therefore we work a lot with our customers around preventions.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Bringing you up-to-the-minute financial and geopolitical news whenever and wherever it happens. I'm Francine Lacroix in Davos, Switzerland, and this is Bloomberg.
Good morning from our global headquarters in New York. I'm Manus Cranny alongside Danny Berger. You're welcome to Bloomberg Brief. Let's set that agenda.
Brace for discomfort. President Trump warns of a little disturbance while defending his trade policies. The Lutnick effect. The Commerce Secretary hints at tariff relief, lifting equities off the worst two-day slump since December. And Germany's whatever it takes moment. The new chancellor readies hundreds of billions of euros in spending. Good morning, Manus.
Danny, good morning. Just how far will they push the discomfort, because this stock market whipped it around yesterday after that worst two-day slump since December. Commerce Secretary will be with us later today talking about relief. Well, relief does not equal reversal. and reversal does not equal a reduction in uncertainty. Stocks, however, are reclaiming some ground this morning. Roll it over to the bond market. Of course, the Nasdaq almost corrected yesterday. Look, the narrative was steepeners in the market. 424 is where we are. The two-year yield steadies itself at 398, but you are looking at a momentum in these yields, the longest drop in yield, Danny, since 2020, as stagflation takes hold. Keep an eye on euro-dollar. It's bid this morning on this almost unconstrained defense spending from Germany, and the euro is rocking away in terms of the upside. So things are shifting on a seismic scale globally.
Yeah, take everything you knew about Germany and their spending and just rip it up. There's also some individual stocks that are moving on those Lutnick comments. Broadcom, I should say the entirety of the chip sector, but here's a look at Broadcom, up 2.5% in the pre-market. It's one of the sectors rebounding. Commerce Secretary Howard Lutnick speaking on Fox yesterday, saying that the administration will meet in the middle, is what he called it, with Canada and Mexico.
And another sector to keep an eye on for relief. Howard Lutnick's comments is the auto sector. General Motors rising pre-market. As I say, this is 4% of the GDP of the United States of America, now tariffed at 25% from Mexico and Canada.
And some earnings to check on for you. CrowdStrike shares falling more than 8%. The cybersecurity company issued a worse-than-expected outlook. It is still recovering from that flawed software update that crashed millions of computers globally last year and likely led many of you to miss your flight.
And in just a few moments, we'll catch up with David Leibovitz of JP Morgan, and later in the hour, Mark McCormick of TD Bank. And don't forget that conversation with the Commerce Secretary, Howard Lutnick. What does relief look like? What is it that may well be offered? Danny, here's the point. What is a little disturbance? What happened yesterday? Did we test the boundaries of where this administration went? Maybe there's a little bit too much pain in this market.
Did we see a Trump put of sorts come in? Trump kind of downplayed that during his congressional address, but I think it's also interesting to contemplate, is what we saw yesterday a growth scare or a tariff scare? Is this just economic data that's been weakening, and then you add tariffs on top of it and it gets worse? Because the things that we saw sold off, things like banks, for example, that is a telltale sign that we are concerned about the economic growth of America.
Look, the stagflation narrative is mounting, so the question then becomes, the rates market leans into the stag side of this, which is 3 rate cuts rather than the inflation side of this. So it's really that rock in the hard place for the Federal Reserve.
Certainly. And look, it has been 2 days of tariff pessimism that dragged stocks lower. Now, a flash of optimism did come in the form of Commerce Secretary Howard Lutnick last night. In an interview, Secretary Lutnick seemed to suggest that there may be some compromising on tariffs coming.
Now, both the Mexicans and the Canadians were on the phone with me all day today, trying to show that they'll do better. And the president's listening because, you know, he's very, very fair and very reasonable. So I think he's going to work something out with them. It's not going to be a pause, none of that pause stuff. But I think he's going to figure out, you do more, and I'll meet you in the middle some way. And we're going to probably be announcing that tomorrow.
Joining us for more is Bloomberg's Kevin Whitelaw, and we again should emphasize that Lutnick will be on with the surveillance team, so maybe we will get that announcement soon, Kevin. But meet in the middle, is this the Trump put coming to realization?
Look, I think we're still trying to figure out, and maybe Trump even himself is still trying to figure out, ultimately, what is the aim of these tariffs, right? And he's unleashed a bunch of tariffs. He's threatened a lot more. And how much of this really is about negotiating? How much of this is about getting concessions, whether it's related to the illegal drug trade or bases of manufacturing or other kinds of trade measures? Or how much is he really counting on revenue from tariffs to fund his priorities, whether it's tax cuts or other spending priorities? He's talked even about getting rid of the income tax. At some point, you can't sort of have it both ways. And so the administration is going to have to ultimately decide what is the point of this and what do they want to do with them. And it's very clear that the jitters you're seeing in the market are related to a concern that, indeed, he's talking about something more structural, something more permanent. And if that does happen, then that becomes obviously a huge, huge potential shock, not just to the U.S. economy, but to some of the global economy, if he really goes down that road. So obviously, I think there's, in Europe and elsewhere, there's a lot of people hoping that Lutnick is indeed representing a rising power within the administration, which we do think is actually somewhat torn between these different ideas.
Well, as he says, it's not a pause, but we need to understand the quantum of relief. Look, aside from tariffs, Trump touched on a number of issues: taxes, Ukraine, Doge, the CHIPS Act. This was all last night. Here's some of the highlights.
The next phase of our plan to deliver the greatest economy in history is for this Congress to pass tax cuts for everybody. We're seeking permanent income tax cuts all across the board, and to get urgently needed relief to Americans hit especially hard by inflation. Your CHIPS Act is a horrible, horrible thing. We give hundreds of billions of dollars, and it doesn't mean a thing. Simultaneously, we've had serious discussions with Russia and have received strong signals that they are ready for peace. Many more have been found out and exposed and swiftly terminated by a group of very intelligent, mostly young people, headed up by Elon, and we appreciate it. We found hundreds of billions of dollars of fraud.
So, Kevin, he talks about a common sense revolution. It was very partisan. It was 100 minutes long. When he used that phrase, little disturbance, this was very much raising the flag. The discomfort is far from over.
No, I think that as long as he's going to keep unfurling tariffs, as long as he's going to pursue elements of this, there's going to be disruption, there's going to be pain, there's going to be questions about what it means for consumers in the United States as well as for businesses. I mean, for businesses just trying to plan their future and trying to figure out investments, a lot of them suddenly really don't know how to think about what that environment's going to look like and what some of that decision-making really means, because they don't know what the landscape's going to be in a couple of years. And so I do think you're at that situation where at some point the market, the players, the businesses, they're looking for some clarity about what exactly is the ultimate strategy that Trump is pursuing when it comes to tariffs, and how serious is he.
Okay, well, we'll get a little bit more information today, won't we? Kevin Whitelaw there with us for the very latest. Thank you very much, and thanks to tariffs becoming a reality. Just look at this. Stocks, the S&P 500, the worst 2 days since December, down almost 3%. Oil this morning looks to be holding its losses. You're looking at that market down almost 4% over 4 days. And 10-year yields back at 4.25. David Leibovitz joins us now from Multi-Asset Solutions for Global Strategy over at JP Morgan Asset Management. David, good morning to you. These markets are in a febrile state. If we look at the narrative, we're going to hear from from Commerce Secretary later today. He says it's not a pause. So then what kind of relief should we be looking for at this current moment?
So I think there are a couple of things going on there, and you know, the base case should be that there are going to be tariffs. I think it would be very surprising, as you know, a number of people have said, to see the whole tariff narrative walked back. I think more clarity on the direction of travel, right, a more narrow dispersion of outcomes is what the market is really looking for, because effectively what's going on here is you're seeing this slowing in growth at a time where policy uncertainty is rising. And that's very difficult for markets to digest, hence the volatility that we've seen over the past couple of days.
So, David, I'll ask to you kind of what I posited to Manis at the top of this show. Is what we're witnessing a tariff scare or a growth scare in markets?
So I think that the two are interrelated to an extent, because the downside that tariffs create from a growth perspective, again, is coinciding with an economy that is simply returning back to trend. And so I think the question that the market is asking itself is, we grew at about 3% in 2024. We're not going to do that in 2025. Are we stepping down to 2? Or are we stepping down to 1? And so it's a growth scare that's being exacerbated by what's going on with tariffs. And again, the broader policy uncertainty and more stick, less carrot, I think is part of what's causing, you know, markets to gyrate here, as we've seen.
So, David, if we're stepping closer towards a growth scare, that builds the stagflation narrative. I'm just curious to get your take. The market's pricing in 3 rate cuts. Is that the right response mechanism from the market if we are heading towards a stagflationary environment?
So stagflation is public enemy number one, right? That's the environment that you want to avoid. Stagflation is not our base case when we think about 2025. And frankly, the Fed easing 3 times this year against the backdrop of sticky inflation and softening growth, I think you'd have to see a fairly material softening in growth for that to be realized. We're still of the view that the Fed will cut rates 2 times this year. That's been our view since since December of 2024. And so we think that there is Fed easing coming, but I'm not sure it's going to be quite as substantial as what markets are currently pricing in.
David, you mentioned the gyrations of this market, and it's that old adage that over any given time frame that markets have momentum and they follow a trend, but in transition periods, they bounce around quite randomly. Are we witnessing a random bounce of a transition period, or have we transitioned already into a new trend that looks like one for vulnerability of risk assets?
So I'm not sure that we've fully transitioned into a new trend. I would point out that growth is not terrible. Inflation has come in quite a bit, and that nominal growth environment is still very positive when you think about things like corporate cash flows and corporate profits. So what I think the market needs to see here is just a little bit of good news to get back on the track that it's been on over the past couple of years. I'm not saying that the S&P 500 is going to have another 20+% year. That would certainly catch me by a bit of surprise, but I do think that stocks, U.S. equities, are higher at the end of the year than they are today. What we need to see is this constant flow of negative news, whether it be around the growth numbers, whether it be around the policy decisions that are being made. We need to see that transition, and frankly, I think it will. I think this Friday's jobs report is going to be particularly important in setting the tone for the month of March more broadly.
Well, that is the tier one, the top of the tier one data. David, Dawn Fitzpatrick yesterday joined us and she said consumer confidence and corporate confidence is falling off a cliff right now. What changes that? Because that is the core. Danny's talked about this in terms of the wealth effect. That is the core of confidence in exceptionalism in the U.S. and global risk assets.
So I think just seeing policymakers make a decision would go a long way in reducing some of that downward pressure on both corporate and consumer confidence. I mean, if you think about running a business, it's very difficult to plan if you don't know what the rules are going to be, if you don't know what tax policy is going to look like, if you don't know what tariff policy is going to look like. If you're a consumer and you're living paycheck to paycheck, very difficult to budget if you don't know what's going to happen to the prices of the goods that you're buying on a day-to-day basis, what's going to happen to the price of the gasoline that you put in your car. And so, again, the policy conversation today is creating this uncertainty, whether it's on the business side, whether it's on the consumer side, and that makes decision-making very difficult. And, economic growth slows when people decide to wait and see. It is imperative that we get past this point where we are today so people and corporations aren't waiting and seeing, because if that's what plays out, we likely have more downside risk to growth than we're currently penciling in.
You could argue investors feel the same way about that uncertainty. David, it's kind of a weird thing to see some of these sentiment readings crash. I don't think it's an exaggeration to say that. Looking at AAII surveys, absolutely plummet in the number of bears rising to 60%. It feels like a time of when others are scared, be greedy, but we're not even off 10% of the highs of this equity market. What do you make of that disconnect between sentiment and, let's be honest, a market sell-off that hasn't gotten that deep yet?
I think you make a really good point, Danny, about the depth of the pullback that we've seen. It's still fairly pedestrian, down mid-single digits from the peaks. Sentiment is deteriorating, and I think, frankly, what's been going on, if we look at the markets globally, is you had a U.S. market that's done very well over the past couple of years, and frankly was sporting a valuation that was unsustainable. You had global investors say, okay, there's clearly policy risk in the U.S. Maybe I'll look to some of these more favorable valuations abroad, and I think that that's a big part of what's driven the performance of European equities over the course of the past couple of months. But now when we look at international markets, they're not sporting the same discount that they were a couple of months back. The U.S. has re-rated marginally. I think, frankly, if we're going to continue to operate in this environment of policy uncertainty, right, you have less dispersion within valuation, right? That means the U.S. multiple comes down, the rest of the world has gone up, but I think, there could well be some more fluctuations in the market as we get clarity here. I think, April 1st is going to be particularly important. We get the big report on trade coming out of Washington. There are still questions that investors want answers to, and I think the fact that futures are up today, certainly isn't sounding the all clear.
David, so brilliant. As always, it is such a pleasure to have you on our show. Looking forward to seeing you in person next. David Leibovitz of JP Morgan Asset Management. Let's get you some other stories now that are trending on the terminal this morning. Shares of Adidas falling. The German sportswear brand said earnings will grow slower this year than investors expected. Shares down a little bit more than 0.5%. That happening even as it builds momentum with its retro footwear. It is known, I will say, for conservative guidance, but analysts said that the latest figures would likely weigh on its shares in the short term.
Within weeks of President Trump wanting the U.S. to take back control of the Panama Canal, BlackRock's Larry Fink got in touch with the White House. Now the world's biggest asset manager will lead a consortium that will buy a controlling stake in Panama ports. The transaction represents the largest infrastructure deal in BlackRock's history.
Meanwhile, China has set an economic growth goal of around 5% for this year. It upheld its growth plan with the highest fiscal deficit target in over 3 decades. The government also unveiled a plan to increase its sales of special bonds to fund more public spending.
Coming up in the show, Germany abandons its fiscal shackles. Bund yields surge. More on the German story next.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
It's your Bloomberg Brief. Danny Berger and Manish Cranny in New York. Germany has announced plans to unlock hundreds of billions of euros for defense and infrastructure investments. The euro is on course for its largest 3-day gain since late 2022. Investors betting that the increased spending by Germany and others will boost the European economy. Pleased to say that joining us now is Bloomberg's Chad Thomas in Berlin. Chad, can you just try to quantify what sort of change this is, the level of change, and just what it means for Germany to have this spending and having the release of the debt brake?
Hi, Danny. Well, it was a real shocker last night when this was announced, and we've had economists saying that this is the biggest change in fiscal policy in Germany since reunification in the 1990s. You have to remember that Friedrich Merz, he's the leader of the conservatives here in Germany. It was his party under Chancellor Merkel who put the debt brake into place. That's the mechanism that restrains the fiscal spending in Germany. So the fact that he came out last night and said that they're going to remove all defense spending from this fiscal limit, and at the same time they're going to have this 500 billion euro fund for infrastructure, that was a real big move. And we, of course, saw the market reaction today with the euro, with bunds, and also with defense stocks across Europe as well.
Chad, good morning to you. You just take this along with the pan-European response and you begin to understand the scale of what we have. But the question is, how much of this can be assumed to be a done deal? Because this is Merce going back to the old parliament, not the new parliament.
Yeah, it's a really interesting thing that we'll see playing out here over the next week. So the old parliament is still the sitting parliament. The new one that was elected a little bit more than a week ago hasn't been sworn in yet. And for these changes that he's talking about doing, he needs a 2/3 majority in the parliament. He doesn't believe that he would have that in the new parliament, so they're actually using the old one to try and get this through. He will need the support of the Greens to get this through. He has been talking with the Social Democrats. They're his likely coalition partner in the new government. The Social Democrats last night said they do back this proposal, but it will, it's likely, Manus, that it will go through, but it will remain to be seen if he does muster the votes next week in the parliament for these measures.
Okay, Chad, thank you very much. We'll track that. No shortage of superlatives from the market this morning in terms of the size and the scale and the impact. Todd Thomas there on the latest release from the fiscal break in Germany. We've been showing you the prices throughout that, but let's just check in, Danny. We've got real sort of shifts in the euro dollar. You've got it touching a 4-month high, the largest 3-day gain since 2022. And I like what George Saravelas says over at Deutsche Bank. It's the biggest and fastest fiscal shift post-unification, and he's going for 110. They're shredding these parity calls.
Yep, he has upgraded his target, saying that this creates upside growth and mutes the impact of tariffs. By the way, the superlative for you, that move on bonds up 19 basis points. If it holds, it will be the biggest one-day move since March 2020, the onset of COVID. We'll have more on that, plus other news for you on your Bloomberg Brief.
In case you missed it, from Bloomberg's coverage at Davos.
Do you think there's one particular thing that you'd like Trump to change in terms of what some people see as the over-regulation of banking in America?
I don't believe, honestly, that we should have a huge amount of deregulation for larger banks. I think that's, you look back at COVID and any crisis, big banks now are strong, are able to step in and being part of resolving issues rather than being the one that creates issues. So I wouldn't really welcome a huge wave of deregulations. What I can see is that, of course, what happened in the US doesn't mean automatically that you will see in Europe or in Switzerland or in Asia deregulation. So the fact is that US banks may become even more competitive internationally through a more benign environment.
Nobody covers Davos like Bloomberg.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Scheduled to speak with the front pages from around the world. First up on Bloomberg, President Donald Trump called for the ending of the bipartisan $52 billion CHIPS Act. Trump called it a horrible thing, he said in his primetime address to Congress. His remarks were met with applause in the chamber that passed the CHIPS and Science Act less than 3 years ago.
Next up, the Wall Street Journal leads with this, that President Trump read aloud a letter that he received from President Zelensky, voicing regret over their Oval Office meeting. He set out his vision of a path to peace. It was his most concerted public effort yet to repair the relationship with Trump. Trump did hold back from lifting a U.S. pause on military aid or announcing a revived minerals deal during his address.
Let's finish off with the New York Times. Leads with the Democrats responding to the president's address. Senator Alyssa Slotkin arguing that his agenda would be costly for Americans and leave them less safe. Slotkin also criticized Trump's foreign policy and accused him of cozying up to dictators and mistreating allies.
Well, coming up on the show, North American tariff relief and Germany's infrastructure boost. A lot of movement in currencies. We're going to catch up with Mark McCormick of TD Bank next on what he sees as dollar strength to come.
What would you say somebody young who's watching this should do if he or she aspires to be like you?
There's one component of our industry that people need to focus on, and it's not technical, and that's communication skills. Focus on being a phenomenal communicator, invest in that. Think about it, we have to convince a company to sell to us. You just don't walk in and buy the stock or tell them, yeah, you're for sale, I'll pay you this price. That takes years of relationship and effort. Why would somebody sell you that billion-dollar software company growing at 20%? Just because? No way. People hang on to these great assets. And then how do you get on the same page with the executive team of that company, even if they're existing or new? It requires just amazing communication.
If you go to a cocktail party and somebody comes up to you and says, I have $100,000 I'd like to invest, what do you would recommend that person do with $100,000? What do you think is a good idea to do with $100,000 today?
Sometimes they do, and I give them the most boring answer ever, S&P 500.
Just buy an index.
Buy the index. You don't have to worry about the quarterly earnings of a company. Did something change? Did somebody change management? You don't have to make this your full-time job. Just buy the index and you're going to be okay.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
From our global headquarters in New York, welcome to Bloomberg Brief. Danny Berger here alongside Manus Cranny. Let's set your agenda.
Brace for discomfort. President Trump warns of a little disturbance while defending his trade policies. The Lutnick effect. The Commerce Secretary hints at tariff relief, lifting equities off the worst two-day slump since December. And Germany's whatever it takes moment The new chancellor readies hundreds of billions of euros in spending. Danny, good morning.
Well, we probably packed, I don't know, let's say a year's worth of news into the past 24 hours. We tried to rebound from the sell-off yesterday, which, by the way, I think the technical term for that would be a reverse N shape, down, up, down again. And now up again. Volatility has been off the charts. The S&P has wiped out election gains since the election. At one point was down 2%. NASDAQ futures lead the gains up 0.7%. Russell 2000 outperforms up 1.2%. Did we witness the Trump put? When it comes to bond markets, that was also a very volatile morning, too. The front end dropped by as much as 11 basis points at one point yesterday, only to end the session higher. We go back down again, down by about 2 basis points in your front end. 10-year yields, that's at 4.2%. But the real movement comes from Germany. A 17 basis point push higher in your German 10-year yield. If it sticks, would be the biggest move higher for German bond yields since March of 2020, the onset of COVID. You see the reaction in the Euro 2, Manus, that off the back of Germany's whatever it takes moment, announcing one of the largest fiscal regime shifts in post-war history.
Well, as you said, Danny, we've had decades worth of policy moves in a matter of hours. Let's take a listen to the late-night remarks from the Commerce Secretary, Howard Lutnick, that pulled stock investors out of that worst two-day slump since December.
Now, both the Mexicans and the Canadians were on the phone with me all day today trying to show that they'll do better. And the president's listening because, you know, he's very, very fair and very reasonable. So I think he's going to work something out with them. It's not going to be a pause, none of that pause stuff. But I think he's going to figure out, you do more and I'll meet you in the middle some way. And we're going to probably be announcing that tomorrow.
Our senior editor, Michael Shepard, joins us now from Washington. Shep, good morning to you. Relief, so we're not going to get a pause. Relief is not a reversal. It does not equal uncertainty reduction. What is it that Howard Lutnick could possibly say in the Bloomberg studio today that really changes the narrative?
Well, it would really have to be, we have an agreement. They have to come forward and say, look, Mexico and Canada have indeed met us halfway, as I said on television last night, and the president is ready to accept it, and we are ready to move along. And during his remarks last night to Congress, in fact, Donald Trump gave no indication really that there was any kind of a break or relief or nowhere near a pause whatsoever for these levies against major U.S. trading partners. And in fact, we heard him signal instead that it would be full steam ahead. Remember, Trump really does see tariffs as an economic panacea. It's a way of balancing these trade relationships that he sees as unfair, and many of his advisors, including Howard Lutnick, endorse as well as being unfair, as a way to solve that while also raising revenue to support a lot of the president's priorities, including all of those tax cuts. So today we may be able to get some communication from Canada and Mexico about moving closer to perhaps a little bit of relief, but it is not going to be a total pullback from the brink on these tariffs. We've already jumped over that, and we're now seeing equity markets really reflect a lot of those concerns about tariffs as well.
Right. We certainly didn't get any new news from Trump in his address yesterday. Again, just saying that there's this idea of what he called a little disturbance from tariffs. Shep, I just want to go through some of the other president's comments yesterday. Let's take a listen.
The next phase of our plan to deliver the greatest economy in history is for this Congress to pass tax cuts for everybody. We're seeking permanent income tax cuts all across the board, and to get urgently needed relief to Americans hit especially hard by inflation. Your CHIPS Act is a horrible, horrible thing. We give hundreds of billions of dollars, and it doesn't mean a thing. Simultaneously, we've had serious discussions with Russia and have received strong signals that they are ready for peace. Many more have been found out and exposed and swiftly terminated by a group of very intelligent, mostly young people, headed up by Elon, and we appreciate it. We found hundreds of billions of dollars of fraud.
Shep, did we come away with this with a greater understanding of what the president's priorities are at this moment?
Well, clearly he is trying to go after, and he spent a lot of time talking about what Elon Musk's DOGE effort is trying to do with the U.S. government, and that is look through all the couch cushions at the agencies for any kind of savings that they can find. Now, what we've seen so far is that a lot of those savings really have not translated into actual savings. They've turned up contracts that were canceled years ago, and some of the numbers just simply don't add up from this so-called Department of Government Efficiency. But that didn't stop the president from reeling off a list of some of the programs, that many of them foreign aid initiatives, that have been canceled or put in abeyance, and he tried to use them as a way to ridicule some of the past administration's priorities as well. And that also included the CHIPS Act, interestingly, Danny, and his call for repealing this measure really is something that chip makers will have to pay close attention to. While the subsidy program has been passed and we've seen these agreements signed with major semiconductor manufacturers, a lot of the money is still in the U.S. government's hands. That those checks only go out on the basis of certain milestones and achievements being reached by these companies under contracts that they've signed with the government. So whatever Intel and TSMC and others are about to get, it's based on those agreements that they've signed. And a lot of it is based on what they're achieving in terms of building plants, hiring workers, and meeting other goals along the way. Right. Now, repealing it is a tall order because this passed on a bipartisan basis, and we don't see a huge majority at all in the House that would be able to get him the numbers he would need to win an actual repeal of the law in Congress.
Mike, so much to keep track of. I know it was a late night for you and an early morning this morning. Thank you so much for joining us, Michael Shepard there. Now, the dollar has been falling for much of the past month. It took a nosedive deeper into the red yesterday. TD's Mark McCormick writing this: we continue to like U.S. dollar upside here, believing that the positioning adjustment and drawdown are complete. Mark, I'm pleased to say, joins us now. He's global head of FX and EM strategy at TD Bank. Mark, it seems like if there's one thing that unites everyone around tariffs, it's that the consensus is that it creates a strengthening in the dollar. Both foes and fans of the dollar think that. So what do you make of the dollar, not just the action for the past month, but also yesterday in the whole tariff scare, getting a weaker dollar out of it?
Well, I think it's been a very challenging environment, largely because there's push and pull factors. I think on the one hand, you can have the markets been complacent on tariffs. We've seen a reduction in risk premiums. We've seen valuations kind of move and positionings adjust, especially the markets kind of move from a very long dollar position to neutral to what now feels like in our models to be very short. At the same time, you've seen a complete collapse of U.S. data. If you look at the Atlanta Fed GDP tracker, it's negative for the first time in years, and also you're seeing U.S. data surprises underperform. So I think what we're trying to pull together is the market's trying to be forward-looking. It's trying to understand a complete readjustment of the global trade order and the existing regime that we've been a part of. And what we're seeing is on the forward-looking side, the America First agenda is now pushing other countries to kind of take care of their own economic policies. So this is what you're seeing out of Germany, the fiscal support and the change in the defense and the spending that they want to see there. But it's coming at a time, if you went through like Trump 1.0 with trade wars, basically what they did the first time around is they put tax cuts and deregulation first, and then they followed up with tariffs. So now what you're starting to see is the data looks a little bit funky. It's been very volatile, at least from the U.S., and people are questioning whether or not U.S. equities are still the main place to be. So there's a rotation and a concern around whether or not the U.S. is really exceptional and whether or not U.S. equities are the place to be, which is basically two pieces of the dollar trade that we're looking at right now.
Mark, good morning. And despite all of this geo uncertainty, one typically buys the dollar. The question that's being asked by a number of proponents this morning is whether this profound geo-economic uncertainty, the highest tariffs since the 30s, pulling military assistance from Ukraine, et cetera, we could go on. But the question becomes then whether U.S. hegemony and exorbitant privilege can be challenged, materially challenged, if not in the short term, but by the end of this year and the rest of this tenure of Trump.
Well, I think in terms of the hegemonic power, it's clear that there's kind of a battle around it. You know, people have used the term, it's a multipolar world, and that seems very clear. And that's what you're seeing from Europe. Europe is essentially saying, you know, Europe is taking care of Europe, America's taking care of Americas, and Asia is basically driven by, you know, an influence around China's sphere. So this is part of what you would expect in terms of, a lack of a hegemonic power is that the power is diffused among a couple different spots. So I think when this comes back to markets, what's very interesting, and this is kind of the pivot point that everyone's trying to figure out, for the first thing, if you don't have the same existing global trade order, you are going to have much higher inflation. You're going to have much steeper yield curves. That's what you're primarily seeing that's coming across in Europe, is we're starting to see a repricing of the term premium and the growth expectations. I think also at the same time, you're going to see what could be a potentially slower growth world. Right now, everyone is very excited about what's happening in Germany and the defense spending. But again, this has to get through a constitutional change. This will probably have to get through courts. So I think most of us should be very skeptical that the numbers we're seeing out of Germany will actually come to the realization. But again, markets work on the expectations of things and they adjust accordingly as the news flow comes out. But I think, again, back to the hegemonic story, like this is what's happening is the world is changing, foreign policy, geo-macro, all these things are adjusting and markets just can't put down a trend and just can't sort it out. So we're seeing tremendous amounts of volatility, like you said, like within a day where it feels like a decade.
Yeah, it's the transition period for trying to find that new trend where markets tend to be bumpy. But when it comes to Germany, we've already seen your peer over at Deutsche Bank, George Saravelos, upgrade his euro target to 110, arguing kind of what you're pushing back against, this idea that we will see more growth and it shrinks the differential between the U.S. and Europe. You have said that you see euro going lower. Would you adjust that at all? Again, maybe not necessarily on whether it will get done, but a market expectation that you will get an easing of the fiscal brakes.
I think an important piece here for anyone who covers FX needs to understand that the drivers you see on a monthly basis and a weekly basis are extremely different than the drivers you see on a monthly and a quarterly basis. Short term is tactical, it's positioning, it's short-term valuations, it's market sentiment, and the longer term is driven by much more complicated factors. So I would say here tactically, for the rest of this quarter, we are still bullish the dollar. We have been looking for the end of this year and into next year a euro at 110, whether it was through a Mar-a-Lago Accord or was it through natural decline of U.S. exceptionalism. What we've been suggesting is the dollar story would peak in Q2. I still think that's the way to trade it. I would say on those short-term metrics, especially when we look at positioning and the things that drive our models and our overlay tools, euro positioning is now in the 80th percentile. So it's basically almost at the max we've seen in the last 6 months. So now what we need to see is the continued positive news flow has to support the euro. And as you just noted in the last segment, the next thing that's coming from the Trump administration is tariffs on Europe, and also a focus on deregulation and tax cuts. So while the U.S. economy is kind of stumbling, at least from a data perspective, our data momentum indicators show that the U.S. is still outperforming Europe. So I think we can totally see this narrative change on a dime, just in a span of a couple of weeks. But I would highlight again, we are looking for the dollar to turn lower. That is a forecast, but our trading prediction is to buy the dollar tactically in the short term.
We're going to test that exuberance of the euro at some juncture. Mark, thank you very much. Mark McCormick there of TD Bank.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
One of the very critical things is that a lot of young entrepreneurs don't realize is that when you start as an entrepreneur, you're not just building your business, which of course you are, but you're also building an organization. And most people don't realize that. And building an organization is not just about hiring people. It's about the culture, it's about the systems, the values, the mission. You know, it's about how you operate, how you do things, how you retain people, how you keep them motivated. So it's all of those things put together. And over time, you realize that, you know, a lot of effort has to go into it. And then eventually you have an organization that has a life of its own. It's, you know, and it's sometimes you look at it and you marvel and you think about, you know, how was this created? And was I the person that was behind getting this thing done?
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
It's Bloomberg Brief. I'm Manus Granny alongside Danny Berger here in New York. Well, Germany announced its pretty shocking plans to unlock hundreds of billions of euros of defense and infrastructure investments. The euro on course for the largest three-day gain since late 2020. Bund's plunging on the back of the shift. Yields are spiking. I think, Danny, you gave us that stat. It's the biggest one-day move in the Bund yield since the onset of COVID, and that was back in March 2022. Joining us now is Ross Matheson. Ross, good morning to you. This is Mercer's do whatever it takes moment. Can you just give us the size and the scale on defense and infrastructure that's on the table? Because there's a great distance between what's proposed and actually delivering.
Well, that's going to be the big question, really, here. We can see, as you were saying, markets reacting today to what is really a very, very proactive move by the incoming Chancellor. He's not even in the chair yet, already working with the outgoing administration to try and get some sort of deal towards Parliament, and that just reflects how fast-moving an environment we're in the world right now when it comes to politics and to defence in particular. So the question is, what can he get done and how quickly? Because obviously he needs to work with Parliament. He needs to get enough parties in Parliament to essentially change the Constitution. And, you know, with his group and Olaf Scholz, the outgoing Chancellor's group, he doesn't have enough. So he's going to need other parties on board to do that. And do those parties feel that they've not been part of this sudden announcement and therefore they're feeling a bit indignant about it? So you need those parties on board to get something done. Do you find that it gets watered down a bit as a result? So this might be the opening salvo, dare we say. This is the big headline figure. What in reality can Merz and Scholz get through Parliament might be something slightly smaller. But either way, it's a really significant moment for Germany. As you were saying, this debt brake has been in place through many a crisis before, the Euro crisis, the COVID pandemic. It took Donald Trump essentially to bust it up and for Germany to say, this is the moment we have to do this. So it's a really big step either way. It's just unclear whether the amount of money that they're talking about is what's going to get through.
And Mark McCormick of TD Bank was just with us, Roz, saying something similar. In fact, he threw cold water over the idea that we would have anything close to what we're looking at. So what does the timeline look like from here on out? What do negotiations look like? How do they take form? What are sort of the things we need to be watching out for?
We need to watch the Greens and all of this, because that's probably the party that they're going to need on board to get something through Parliament. And we can see already the Greens saying, hang on, we've been ambushed a bit by this announcement. We didn't know this was really going to be coming so quickly. And so now they're going to come in with their list of concerns, or rather demands, about this plan. And so the parameters of, again, could change. We also have the far right, you know, the AfD, which will become the most important party in opposition. What is their view? Are there legal challenges? So, yeah, a lot of obstacles ahead, potentially.
Roz, thank you so much. That is Bloomberg's Roz Matheson. Now, over in China, the government has set a bullish growth target of about 5% for this year and a record high fiscal deficit target of 9.9% at the latest annual National People's Congress. For more, let's bring in Bloomberg's Min Min Lo, who joins us now from Beijing. Min, there had been this idea that China was reserving fiscal power until they understood the impacts of tariffs. Is this it? Is this the fiscal bazooka finally coming to realization?
Well, I am not sure I would call it a fiscal bazooka at this point. Yes, the growth target is pretty aggressive, but it's in line with expectations, the 5% growth target, because consensus forecast is 4.5%. So to get to 5%, they really have to pull out a significant amount of stimulus to boost the economy. And the deficit target does match that. It's set at 4%, which is the highest in decades. The local government special bonds, as well as the sovereign special bonds, the quota for those had also been raised as well, but that's where it had fallen slightly below expectations. Some analysts say that the fiscal budget spending may still not be enough to hit that growth target, but we'll have to see, because it's possible that the government will revise the budget mid-year as well. They could be keeping their cards close to their chest for now while they work out what the final tariffs will be, because at this point, there still hasn't been any high-level official talks between President Xi and Trump to discuss what the final tariffs will be going forward. So we'll have to see. But this is pretty aggressive. And what stood out to me the most in that government work report is the priority of the government. The first number one task listed there is to boost domestic consumption. It's no longer about promoting those so-called new quality productive forces. That was the number one task last year. Now that's relegated to number two. The focus this year is all about boosting domestic consumption. And that signifies maybe not that there is a strategic pivot away from that industrial policy, but it's a more balanced sort of macroeconomic framework that they're looking at here.
Well, still, the survey that we've done, 77 analysts think it's only going to achieve 4.5% growth, not the 5%. Where are we in policy mix? Because as tariffs arrive, the response mechanism has been to devalue the currency, but that has been restrained, even though the market sort of saw that as being one of the ballasts to tariffs. So how do they boost consumption in a rising tariff environment with a steady state currency?
Yeah, the currency, again, that was mentioned in the government work report as well. In terms of the currency policy, the government is still going to keep the yuan stable in a balanced and adaptive manner. And so far, year to date, we have seen a laser-sharp focus from the PBOC to focus on defending the yuan. It looks like they wouldn't want to be accused of manipulating the currency or deflating the currency to offset tariffs, especially given Trump's recent comments naming the yen and the yuan specifically in that currency watch list. So we'll have to see when exactly the PBOC would shift the policy towards that more accommodative monetary policy. That's something the PBOC governor has been pledging, but they haven't really moved towards that yet because, as I said, they've been prioritizing supporting the yuan for now. But in terms of boosting consumption, according to the government work report, they will be promoting income growth. They will be raising some of the benefits, for example, the medical benefits, the pension benefits for rural residents by 20 to 30 yuan. And that's only just $2 to $4, pretty meager if you ask me. So to what extent that would actually cause people to lower their precautionary savings is still a big question. Of course, they're also doubling the amount of subsidies that would go toward that equipment upgrading program to promote people buying more household appliances and gadgets. But we'll have to see how the actual implementation of these policies will take place in the next weeks and months.
Min, thank you so much for joining us. Min Lo there in Beijing. This is Bloomberg.
countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Get you set up for your trading day on this Wednesday. More retail earnings before the bell. Foot Locker and Victoria's Secret. We'll also get economic data, ADP. That comes at 8:30 a.m. ISM services and durable goods at 10 a.m. The Fed will also release its beige book at 2 p.m. And the event that you do not want to miss that will likely move markets, it is Commerce Secretary Howard Lutnick at 8 a.m. Eastern Manus.
Indeed. And stocks to watch, Danny. Autos, banks, and chips all get that nice bounce because we want to understand from Commerce Secretary, don't we? He said, yes, it's not a pause. Well, then, if it's not a pause on Canada and Mexico, what is the relief?
Well, that is it for Bloomberg Brief. Surveillance is up ahead with the conversation with the Commerce Secretary. This is Bloomberg.
Institutions you've been very philanthropic with is your alma mater, Harvard. But recently, you've been very public about your criticism of the way Harvard handled the events of October 7th and their aftermath. Could you talk about that now?
The first reaction of a group of 34 Harvard student clubs on the morning after October 7th was to put out a statement saying that Israel was 100% responsible for the acts of Hamas. And my view on that was, that's ridiculous. You can come out and say, look, I'm very unhappy about Israel's treatment of Palestinians in the West Bank, or you can say, we can talk about the Gaza Strip, but you can't support terrorists, and particularly terrorists that rape and pillage and murder and burn and take hostages. Well, I got actually a text from a CEO in my industry. He's like, Bill, you know the people at Harvard. I'd like to know who the students are behind these clubs so I make sure I don't inadvertently hire them. And so I tweeted out that sort of made that point and caused a bit of a firestorm. And I got a lot of pushback. Why are you picking on students? And I said, look, you can't hide behind a corporate entity if you're going to support terrorism.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
When you think about all the catalysts, the risk is not quite balanced versus the reward at this point.
The market's been fighting off kind of recession talk now for 2 or 3 years.
Tariffs and consumer sentiment are the big issues that are likely going to be depressing most retail stocks for the weeks and months to come.
The strategists are getting negative. The traders, the investors are nervous about what this means.
If sustained, these types of tariffs could shave minimally 0.7 off of growth for the year, maybe even a full percentage point.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
What a morning. Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Wednesday, dazed and confused. Your equity market bouncing back. Equity futures, your scores look like this on the S&P 500 advancing 0.6%. On the NASDAQ 100 up by 0.75%. On the Russell up by 1.2%. The prospect of a trade compromise juicing equities this morning. But take a step back. Have a look at the global economy right now, and for that matter, global markets. Let's start with Germany. 2-year, 10-year, 30-year, double-digit moves on a German yield curve, up by 20 basis points on a 10-year maturity. That's Germany. Think about China, coming out with a 5% GDP target and pushing more deficit spending as well. We are seeing some changes in the global economy that people have been pushing for a long, long time, and it looks like we might get it.
We are getting an expansion potentially of the deficit in one of the countries that was the example of what it meant to not borrow any money, and that is Germany. The idea that they could expand their spending by 500 billion euros over 10 years for infrastructure on top of doing whatever it takes, the Draghi moment for their defense spending, is shifting the goalposts. Does it actually come through now is the question.
It's a regime change. It's a whatever it takes moment for Germany and arguably for the global economy. We're seeing shifts we have not seen for decades upon decades upon decades. These are things we've been talking about for such a long time, and here we are. I think we've got to ask a lot of questions about trade, about fiscal policy. Let's start with fiscal. Just how much space is there for Germany to go through with what they're trying to do? And just bear in mind, I know we're not talking about this right now. I know the president's celebrating a big, beautiful drop in interest rates, and the bond market means a lot to them at the moment, and they're celebrating that. I've got all that. Later this year, they're still going to pass, at least attempt to pass, a major tax bill at a time when Germany is trying to push this through.
So on the surface, the U.S. is pledging fiscal restraint that looks different than what we're seeing, at least on the surface, in Germany, in China. What actually happens in practice is probably not going to be that. The U.S. is likely to expand its deficit, and you are correct, and you raised this point yesterday, and I think it is the question to ask. How much capacity is there left in this global market that is tired of potential inflation to finance some of this deficit spending that we're seeing around the world that is no longer focused just potentially in the United States?
Remember the Tariff 101 rulebook for financial markets? Tariffs on dollar stronger, tariffs on dollar weaker. That's a big change, and that does not help. The FX channel is not assisting. Euro dollar, I hope you paid for the vacation in Europe up front. Euro dollar 107, new highs for the year.
George Saravillas of Deutsche Bank, who will be joining us later this hour, came out and said that this was a seismic shift, the announcement in Germany yesterday, that this caused him to change his view to bullish, outright bullish the euro versus the dollar with a 110 goal. 110. We're not talking 120. He's not talking about a new wave of growth. Suddenly, it is not just a question of the U.S. penalizing everyone else with tariffs. It's the idea that the rest of the world could see some signs of growth. At the same time, the tariffs more broadly have shifted to a degrowth, a disinflationary, a suppression to the U.S. dynamism.
George is going to join us a little bit later this morning. The euro stronger, the dollar weaker. We begin this morning with our top story, the president on the American economy.
For every one new regulation, 10 old regulations must be eliminated. The next phase of our plan to deliver the greatest economy in history is for this Congress to pass tax cuts for everybody. And I have also imposed a 25% tariff on foreign aluminum, copper, lumber, and steel. Tariffs are about making America rich again and making America great again, and it's happening, and it will happen rather quickly. There'll be a little disturbance, but we're okay with that.
How much disturbance and for how long? The president's comment coming after Commerce Secretary Howard Lutnick suggested a deal to ease tariffs on Canada and Mexico, and that deal could be announced later on today. Anne-Marie joins us now from Washington for more. Anne-Marie, let's get straight to it. A compromise, how soon?
Well, when it comes to the Commerce Secretary, he said we're going to get that announcement today from the president. But it was interesting, of course, because the president didn't talk about it at this moment when he was addressing the nation. He could have talked about this potential off-ramp they have, what the Commerce Secretary Howard Lutnick called yesterday, meeting in the middle when it comes to Canada and Mexico. He said not going to be a pause, Howard Lutnick, but he said, but the president is reasonable. We could see him meet in the middle. Instead, the president doubled down on his tariffs. He seemed committed to the cause. It was just in that moment, that key quote. There's going to be a little disturbance, but we're okay with that. Great question, Jonathan. What's the disturbance? Because you mentioned earlier at the top of the program, he mentioned the bond market. The president didn't mention the elephant in the room if you were a financial investor or the market, which is the fact that we did see a pullback when it comes to equity. So that's going to be a key question today when we speak to the Commerce Secretary. What exactly is the plan? Because yesterday, the president didn't sound like he was looking for any off-ramps when it comes to trade.
Anne-Marie down in Washington for us throughout this morning. Later on this morning, 8 a.m. Eastern Time. Do not miss this. A conversation with the Commerce Secretary, Howard Lutnick. A timely conversation coming up later on this morning on Bloomberg Surveillance. Joining us now to discuss, Peter Cheer of Academy Securities. Pete, good morning.
Yeah, good morning.
What a change we're seeing in the global economy. Where'd you start?
One, I think we're all talking about trade flows. We should maybe be talking about capital flows, right? One of the things that the U.S. has clearly benefited from the last several years is capital inflows. And I'm wondering if this time, as the dollar's weakening on tariffs, you're starting to see Europe grow. And that was just Germany doing, right? We haven't even seen anything out of EU yet. And I assume they will follow Germany's lead because normally, you know, they all dicker around for ages and ages. And then someone does something. All of a sudden, Germany, like, woo, went straight to this. I think capital flows could become an issue.
The U.S. president and his policy at the epicenter of all of this. Love or hate U.S. economic foreign policy right now. It is at the epicenter of changes we're seeing in China, changes we're seeing potentially in Germany, arguably pushing them to do things that are good for them. What I'm trying to figure out from the capital story, are we seeing a policy mix in the United States that will attract capital or push it away? And are we seeing a policy mix in Germany and China that will pull it away at the same time?
I think both are true. I think we are pushing it away, and it's starting to get pulled away. I think people are looking at this. I think, yes, we will get some concessions from these countries because they have to. It's very hard to live with 25% tariffs. But I think we've set in motion a real economic change where people are turning to other people. Again, you look with Canada and Mexico, and I think even Lutnick mentioned it yesterday, right? This went against the USMCA Act, which Trump had been part of putting on, right? So if you're a country, the president who put a deal on has now kind of changed the terms pretty dramatically. Yeah, you probably have to do some acceptance because you can't live with the short-term pain, but I think you're figuring out longer-term solutions. And so far, we've been saying China's become probably the big winner of this, right? We had basically bipartisan support that China was our biggest #1 adversary. We were supposed to go after China. China seems to be playing this very coolly, right? They have not been coming to the table. They seem to be sitting there. They're going to do their own thing. I watch FXI and KWeb. I like those. I think they're going to outperform. They've been still outperforming even this morning with our little bounce in the U.S. They're having a bigger bounce in China. I think people are going to turn to them. They're going to be forced to turn to them, which is not a good thing for us longer term.
Let's put that into market terms. It's early days. It's only been 2 days. But what we've seen is dollar weaker and yields up. This is exactly what people did not want to see. How much do you think that this is a lasting trend? And how much do you think this is a blip on the heels of headlines that are going to be much more complicated to be put into action?
I think that we're going to move around, we're going to bounce around, but I think this is really the potential of a trend, right? Germany's going to need to issue debt. Europe's going to need to issue debt. China's going to need to issue debt. And the foreign buyers of our debt now might have more alternatives. Like, you know what, if I can get a better yield in Germany, do I want that? And our positioning's been so erratic. So, yes, the tariffs are only in place for a few days, but we've been talking about this basically since the election, since the inauguration, and it's been more heightened. And we're getting this back and forth. And also, I think part of this is now, is Trump playing from as strong of a hand as we believe, right? Russia now has to come to the table at some point, right? Everything's been about Ukraine and peace. We haven't heard Russia's view on any of this, I don't think, how close we are there. All these other trading partners, what are they going to do? Some that's going to be reaction, but even you saw Canada trying to impose tariffs back. I don't think Canada can survive very long necessarily without finding other trade partners, but you're forcing that to happen.
We're talking about capital flows, but is there an absolute level at which when you have so much debt already in the world and you have a number of countries that are looking to raise even more, does that elevate yields more broadly? Does this mean that we have a higher floor underpinning a lot of the bond yield space?
Yeah, and I think even, yesterday when yields were going lower for a little while, it's not affecting the long end anywhere near as much. I think most of the day, even when yields were rallying at the front end, as stocks were selling off, the long end, I think the 30-year was still slightly higher in yields. So we're at, 425 on 10s? You're not getting that movement in 10s and longer anymore, and I think that's because you are going to see competition for that space, and we are going to have questions about where the U.S. is headed on this. And I'll even go back to, they spent hours, it felt like last night, talking about some of the stuff Doge has found. It felt all fairly trivial, right? Where are the real billions and billions and billions of savings? And I was kind of personally annoyed. We went through the Social Security, and they talked about the 350-year-old person, 250-year-old person alleged. That's two people. Haven't we figured out from the records, do these two people exist? What's the situation? Like, there are ways to fix this.
They're 350, they probably don't.
Right, and they're probably not actually receiving Social Security, so let's just admit, okay, there's a coding error here or something, but it was trivial because the person wasn't receiving money anymore. So it felt like we're blowing these things out, and I'm not seeing, these real efficiencies that I was hoping to see, to be honest.
That's the United States. Let's sit on Germany just for a while. Can we put up the German yield curve? What a move we're seeing. 2-year, 10-year, 30-year. 10s right now are up by close to 20 basis points. When you see moves like that, I'm looking at the equity market, the DAX is rallying by 3%. I get it, people just see this as good news. But when you look at the bond market, is that move to accommodate extra issuance, or because we're looking at better growth, a better profile for economic growth across the continent?
Probably a little bit of both, right? I think those two are going hand in hand. There is going to be higher issuance, so that's going to have to come out. Again, Germany's been hard to own as a bond investor, right, because the yields are so low. So all of a sudden, I think they will see really strong demand for their bonds, and I think that's part of growth. And again, anything that solves Russia-Ukraine will really benefit, I think, the EU, right, especially Germany. You are going to see rebuilding there. I think they're going to try and get in there. And that's, again, we're going to see this competition. I think, yes, we want the rare earths, critical minerals, so does Europe. There's going to be, I think, a lot of competition for being part of whatever, rebuilding occurs there.
So let's get to some trades. Longs you like right now, shorts you like right now.
So I continue to like China. I think I now have to add more aggressively Europe. This does feel like a real change there. I still do not like the NASDAQ 100, for example. That's kind of been I think that's still overdone. It might rally a little bit more. We might have some, decent trade news. So I'm less bearish than I was, a week and a half ago. On the other hand, we've had a pretty nice move. I think this continues to go lower, though. I think people pull out, the valuation questions are there, and we have this erratic policy that's too hard to invest in those, and it's going to impact the high flyers most. In the U.S., I have still liked some of the chip parts that are, more domestic makers. I continue to like anything that's going to be part of, he talked again, drill, baby, drill. We've been trying to say refine, baby, refine. And I think more what we've been trying to change the narrative is anything that's good for national security, that equals national production, you want that, because we are going to become more independent.
If an investor were to ask you, is the Trump put dead, that the Trump ability to come in and save the market, is that off the table? What would you say?
I think he doesn't care about that right now. I do think when I look at all the policies, everything he's said and done, the one theme that I think is consistent is if you say he wants a legacy of rebuilding manufacturing in the U.S., he wants to leave the presidency with a real middle class, he does not care about those equity markets right now, right? That's not his focus. It's things to get this job, and I think he is deadly serious when he says we'll have to go through some pain. So I think in his goal, he does not care about 10, 20% moves in the S&P 500 anymore.
Trump move, Trump put, reincarnated, come back as the bond market. The bond market gets the mention last night in the address to a joint session of Congress. We don't hear about the stock market at all. That's a shift. I think we've seen that shift building over the past month.
Is the decline that we've seen in yields so far this year considered a victory? And I want to ask every corporate executive officer that question at a time when potentially that means they could borrow more, but do they want to?
Opinions shift wildly from day to day. Just think about this. Monday on the DAX, the best day since 2022. Tuesday, the worst day since 2022. This morning, the best day since 2022. Peter Chair, I can't keep up. Peter Chair of Academy Securities, thank you, sir. Let's keep an update on news elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Some more details from that joint address to Congress where President Trump defended his tariff plan, saying that it would raise trillions in revenue, rebalance trading relationships, and acknowledge that there could be some economic pain. Trump's speech focused on issues like border policies and DEI, with some discussion of consumer prices and inflation. Now, in Germany, the country will amend its constitution to unlock hundreds of billions of euros for defense and infrastructure investments. Chancellor in waiting, Friedrich Merz, has planned a 500 billion euro infrastructure fund investing in priorities like transportation, energy grids, and housing over 10 years. Goldman Sachs will look to cut between 3 to 5% of staff. A person familiar told Bloomberg that the latest round will take place in the spring, that is earlier in the year than usual. The Wall Street Journal earlier yesterday reporting that Goldman will focus on cutting vice presidents after hiring too many in recent years. And that's your brief, John.
Hey, Danny, thank you. More from Danny in about 30 minutes' time. I'm next on the program, teeing up a compromise.
Now, both the Mexicans and the Canadians were on the phone with me all day today, trying to show that they'll do better. And the president's listening because, you know, he's very, very fair and very reasonable. So I think he's going to work something out with them.
Is that compromise just around the corner? Joining us next is Dan Clifton of Strategas, and later at 8 a.m. Eastern Time, a conversation with the Commerce Secretary himself, Howard Lutnick, from New York City this morning. Good morning.
Bloomberg brings you breaking news 24 hours a day, powered by 2,900 journalists and analysts in more than 150 offices across the globe. Bloomberg Television. Context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
It is difficult to overstate some of the changes we're seeing underway in the global economy. Just amazing. Some major stories developing. Let's start with equity stateside. Equity futures positive by 0.6% on the S&P, up by 0.75% on the NASDAQ. We've got a bounce this morning. We're looking potentially for a compromise between the United States, Canada, and Mexico. In the bond market, no compromise coming from the German government. A whatever it takes moment. The potential for a 500 billion euro infrastructure fund. Check out those moves. 20 basis point move higher on a 10-year bond yield over in Germany, pushing 270. These are huge changes for German fiscal policy. The front end of the curve up 13 at 216, and that ECB meeting just gets more and more interesting as the hours pass by. Under surveillance this morning, teeing up a compromise.
Now, both the Mexicans and the Canadians were on the phone with me all day today, trying to show that they'll do better. And the president's listening because, you know, he's very, very fair and very reasonable. So I think he's going to work something out with them. It's not going to be a pause, none of that pause stuff. But I think he's going to figure out, you do more, and I'll meet you in the middle some way. And we're going to probably be announcing that tomorrow.
So here's the latest today. Commerce Secretary Howard Lutnick suggesting President Trump may offer a pathway to tariff relief for Mexico and Canada. Lutnick's comments follow the market posting its worst two-day slump since December. Anne-Marie joins us now from Washington with more. AMH, we talked about this briefly. This is a shift already, a shift that didn't even last 24 hours of having tariffs on Mexico and Canada.
It's a huge shift. Howard Lutnick coming out, the Commerce Secretary, saying they're going to be potentially this olive branch. They're going to meet in the middle. They're going to be announcing it. What was so interesting, Jonathan, is that the president didn't mention any of it last night when he had this prime time viewing in front of the American public. He did say, though, there'll be a little disturbance, but we're okay with that. And that's the big question this morning. How much of a disturbance are they willing to take on when it comes to this White House and the impact tariffs are having on equity markets, which the president didn't even mention once yesterday? Let's bring in Dan Clifton. He's over at Strategic Securities. He's a partner there and, of course, head of policy research. Let's first start with Canada-Mexico.
Sure.
Commerce Secretary Howard Lutnick says potentially there's this pathway for a compromise. What does meeting in the middle mean?
Yeah, so let's just take a start from the beginning. Mexico and Canada were here negotiating last week. They didn't reach a deal. The president put 25% tariffs on both countries. And I just want to explain the magnitude of that. That's 0.5% of GDP. With retaliation, it's more. The economy is slowing. That would really damage both of their economies. It would damage the U.S. economy. So it just doesn't look sustainable at that level. And what the president's staff are saying is that if there's more that Mexico and Canada are going to do, we can meet in the middle. Does that mean a lower rate? Possibly. Does that mean that maybe autos get exempted because they are complying with the USMCA? But there are some issues that the president's worried about, like Canada's digital service tax, which he thinks is a violation of USMCA. He wants to see Canada doing what Germany is saying they're doing by investing in their NATO budget. So there's a specific set of requests that they're probably going to need to get to. And I think the cudgel of putting those tariffs in place is speeding up those negotiations.
I'm glad you mentioned the auto sector, because last night President Trump did say very briefly that he spoke to the top 3 car makers, the CEOs, yesterday. And we know that the auto sector has not been happy with these tariffs. The Ford CEO is saying it's going to blow a hole in the industry. Is that what is your base case?
Yeah, so let me take one step back again. This is the equivalent of raising the corporate tax rate by 10%. And it disproportionately falls on these sectors like auto. So the auto companies are going to the president and his team and saying, this is existential. You like all that support you have from the union workers? They're going to be out of a job if this happens. And so that's what they're trying to do now. They start off very big, and then they work their way in and say, where do we need to provide relief? Autos are one potential area that's probably going to be top of the discussion.
So is it a lower rate for autos, or is it a carve-out?
So it could be a carve-out. And I don't know what it's going to be, but it could be a carve-out. I think that there could be a lower rate as well overall within the USMCA, where it's not just 25%. I think that number's got to go lower. Remember, members of Congress are going to be hearing about this in their districts. So the political blowback of putting tariffs on Canada and Mexico is very different than China. And they're going to learn that as it starts to feed into the home districts.
Yesterday, the president mentioned he likes seeing interest rates drop, big, beautiful drop. Didn't mention the equity markets once, but at the same time, we did see an equity market pullback. The Commerce Secretary showed up on Fox News and talked about this potential meeting in the middle. Is that where the Trump put is right now?
Yeah, I wouldn't say that. I think that this Trump is going to be more aggressive and less sensitive to financial markets in the short run. And Marie, we just had a huge 30% run up in equity straight through last year into this year. We're probably going to get some pullbacks, high valuation, slower growth, policy uncertainty. It all makes sense to me. But what we're starting to see from the president is a major shift in policy, moving the country away from big fiscal policy and tight monetary policy under Biden and moving it in a reverse direction, tight fiscal policy, tariffs, spending cuts, and trying to loosen up the monetary policy, trying to get other countries like Germany and China to do things that we don't have to do. And when you look across the headlines this morning, you are starting to see that Trump is getting countries to do things that they have said no repeatedly. They're starting to come in, and the world is probably going to be better off for that. But there's a bit of a transition, and people are going to feel uncomfortable.
He certainly is internationally, especially when it comes to what we're seeing out of Germany and Europe writ large. But I have to push back on fiscal spending. The president said yesterday, we're seeking permanent income tax cuts across the board, then reiterated his calls for no tax on tips, overtime pay, and Social Security benefits. Well, how are we going to pay for that?
So if you look at where we are today, we're going to extend all of the Trump tax cuts. That means everybody's going to get the same tax cut next year as they get this year. They're then going to offset that with spending. So on net, you're going to have austerity in 2026, regardless. Is there going to be enough room to then put no tax on tips, which is a small tax cut? But what about a domestic corporate tax rate for manufacturers? That would be a big change, and it offsets some of the tariffs. But my sense here is that the deficit is going lower. We're going to have a huge April tax season because of the big run-up in the equity market, and you're starting to see some of the spending begin to slow. So as soon as we get out of tax refund season, which will be mid-March, and we start moving into tax payment season, you're going to start seeing the deficit come down. And I got to be honest, even if you do a half of the USMCA tariffs, that's going to be $75 billion of revenue alone, and you got $40 billion on the China tariffs. So the tariff revenue is picking up in places. It's just not taxes, so it doesn't look like taxes. And my sense here is the deficit will be lower by the end of the year.
We just have a few moments left. Quick question.
Yeah.
Next week, are we headed towards a government shutdown?
I think that we could shut down. I thought that we were starting to make progress. Cooler heads were beginning to prevail. You're starting to see the bid-ask begin to open up. Democrats have to be very careful, because if we go into a shutdown, then Trump can do anything he wants to shut down the government. Right now, he's restricted by some laws, and Republicans need to be careful. This is the way that they're presenting themselves to the U.S. The reason why I think Trump's speech was so important last night is that Trump's momentum was starting to wane. He was able to re-energize his supporters last night. A shutdown just kind of puts a big rut into that next week. So my sense is they're going to figure out some way to do a punt and do a temporary extension.
Classic Washington.
Build more roadway and then try and buy themselves some time for a longer deal. But we're dealing in probabilities here, and I would just say that it's 50-50 on a shutdown right
Dan, thank you so much.
Thank you.
Jonathan, Lisa, Dan Clifton there, Strategic Securities Partner. What I take away from that conversation is today, when we potentially get that announcement, Jonathan, watch the auto space.
Anne-Marie, appreciate it. More on that a little bit later on this morning. The day after the president puts 25% tariffs on Mexico and Canada, we have a guest on the program saying the global economy might be better off for it because of the things it's making China and Europe do. We'll talk about that in just a second. George Saravelis of Deutsche Bank on Germany's whatever it takes moment from New York City. This is Bloomberg.
Is the Vivian Tom clientele? Yeah, power women, like the dragon women. They're lawyers, they're CEOs, they're all important decision makers, women in the world. Why do you position your products for this group of women? When I started, designing, I always want to do something that is empower women. When you take a look at your store, there is something for everyone. Take a look at the T-shirt, for example. My customer growing, like 30 years already, so they become more powerful. I also want to grow my Gen Z audience too, They are like in the 20s, so it's a more affordable price for them. And then, my powerful woman's daughter wearing their mom's dresses, and they feel that the power, the energy. So now they come back to the store and they buy more.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Two-day losing streak on the S&P 500, looking to snap that this morning. Equity futures positive by 0.6%. On the Nasdaq, up by 0.75%. On the Russell, up by 1.2%. 2 days of declines. We're down by about 3% over that period. In the bond market, we have seen a big, beautiful drop in interest rates. The President of the United States addressing a joint session of Congress yesterday evening, celebrating the move we've seen in the bond market. The 2-year at the moment, 396.76. The move in the bond market, though, and here's the wrinkle in the theory, the move in the bond market has been off the back of weaker than expected economic data. Don't lose sight of this later on this morning. ISM services. That might get lost in all the conversations about these big shifts we're seeing elsewhere. I understand that, but that data point is still important. ISM manufacturing beneath the surface was pretty ugly. Will you see the same thing confirmed by ISM services a little bit later?
At a time when a whole host of different economic data have all been pointing in the same direction, and right now this market seems much more attuned to the idea of weaker economic data than it does stronger economic data. To your point about lower yields, there is a real question of whether these lower yields are welcomed by an administration that also wants growth and also wants to plug a deficit gap with incoming revenues. How much can yields go down before it is no longer a positive put on the economy?
And they've got a big tax plan they want to push through a little bit later this year. Shift to Germany. Check these moves out over in Europe. Euro dollar briefly breaking 107, 106.80 right now, positive by 0.5%. The equity benchmark in Frankfurt, Germany is high by 3.4% on the day. And check out these moves in the bond market. The 10-year up 19 basis points. The 10-year bond yield in Germany, 268. I think we have to reflect when it comes to Germany on where they've been over the last century, conditioned by the experience of the 1930s. Absolutely determined not to repeat that. Conditioned by it, and therefore you get this situation. I remember this, and I'll share this story with you now. Wolfgang Schäuble, the former German finance minister, when he stepped back from government in 2017, people of the finance ministry went outside, stood in a circle dressed in black to celebrate the Black Zero. That was something they were very, very proud of. And the shift you're seeing, I really don't think you can overstate this. The shift you're seeing potentially in Germany with the prospect of a 500 billion euro infrastructure plan is absolutely massive.
Especially because it's being supported by some of the architects of that debt break that we saw put into effect, I believe officially in 2009, but leading up to it, with questions around how you emerge from that post-war period. A real question now of just how much gets passed, whether this is just the beginning at a time where that's for infrastructure. But we have heard whatever it takes for defense spending, and that is still to come.
More in Germany in just a moment. On our radar this morning, President Donald Trump promoting his tariff and trade agenda, saying any resulting economic pain would be a little disturbance that Americans would be able to overcome.
You and Emery both asked the absolute correct question, which is, what is little? What is disturbance? How do you define that? Is there a disturbance that is no longer little that they need to respond to? Is this basically President Trump saying, remember that that Trump put on equities? It is no longer in place. A question of what the ultimate goal is. And I'm very curious to speak with Howard Lutnick later this in this show, because he will be talking about how there might be room for negotiation. I want to understand what the plan is, and then why President Trump didn't mention that or allude to that in any capacity, where he kept doubling down on tariffs and saying this is the path ahead.
If you're just joining us, the Commerce Secretary will be joining us in about 90 minutes from now, so 8 a.m. Eastern Time. Look out for that. Lots of highlights in the President's address yesterday evening, including this one. President Trump reiterating his demand for an end to the Ukraine-Russia war.
Regarding the agreement on minerals and security, Ukraine is ready to sign it at any time that is convenient for you. Simultaneously, we've had serious discussions with Russia and have received strong signals that they are ready for peace. Wouldn't that be beautiful? It's time to stop this madness. It's time to halt the killing.
So 1-2 boost for the Europeans and European markets. If you get peace, 1, you get spending, 2, that's the reason you're seeing these moves across the continent.
And we're going to be speaking with George Saravelos, who has changed his call. The point, though, that I really want to emphasize is people are changing their call to a little more optimism. This isn't a runaway type of move that we're seeing in markets, and there's still a whole host of skepticism that all of these things will come together. And when it comes to Ukraine and Russia, there's still key questions of what this path to peace looks like at a time where we've heard a lot from the Ukraine side. We haven't heard so much from the Russian side in terms of what the calculus is there.
Let's get to the German side. Germany would unleash hundreds of billions of euros for defence and infrastructure investments. Chancellor in waiting, Friedrich Merz, saying his administration will do whatever it takes to defend the country. Joining us now, Bloomberg's Chad Thomas in Berlin. Chad, welcome to the programme, sir. I think we have to take a step back and think about the history of all of this. The love affair with the so-called Black Zero. Is it facing a divorce?
Yeah, John, I was listening to you and Lisa talking this morning about that photo that they took when Wolfgang Schäuble stepped back as finance minister. It really can't be underestimated when we talk about what a shift we've seen overnight in Germany by the chancellor in waiting, Friedrich Merz. And we have to remember that this is his party that put the debt brake into place. And the fact that he's not only saying that they're going to spend this $500 billion on infrastructure, but basically they're going to take defense completely out of the debt brake, and that they're going to spend whatever they need to on defense. We're hearing privately that that will also be in the hundreds of billions. They don't want to say publicly how much they're going to spend because they've said they don't want to let the Russians know. But essentially, we're expecting that the defense side is going to be a huge pot of money as well.
Eurasia Group calling this fiscal policy on steroids. Chad, that's not something we typically associate with Germany. They've clearly got the willingness. Can we talk about the ability? How easy is it to get this through the German government?
Yeah, well, that's the interesting twist here. So in order for this to pass the parliament, they need a 2/3 majority. And they're concerned that the parliament that was just voted in, the election, of course, was only just a little over a week ago, that they won't have the 2/3 majority in there, in part because the far right did very well, as you remember, in the election, and they're not likely to support this measure. So they're going to use the old parliament to push this through. They still have a couple of weeks before the new one is sworn in. What it means, though, is Chancellor Merz, he, of course, has his own party backing this, and the Social Democrats. They'll also need the Greens to support them as well. The Greens are likely to do that, but again, there's still a few steps here to go, but it looks like this will get through the parliament very quickly by German standards sometime next week.
Hey, Chad. A busy few days for you and the team, I'm sure. Appreciate your time. Chad Thomas there of Bloomberg, out of Berlin. Check out the bond market this morning. Yields higher across the curve by double digits. Moves we don't typically see over in Germany, up by 19 basis points for the euro. New highs for the year. A stronger European currency against the dollar. George Saravelos of Deutsche Bank writing, it is hard to overestimate the scale of change taking place in global economic and geopolitical relations in just a matter of days. George joins us now for more. George, welcome to the programme. Let's start with your call on the euro. Talk to me about the change.
So there's really two key components, John. The first one is very much this shift coming out of Germany, which I would call generational. We have been expecting some sort of shift over the last 2 weeks. As soon as the election was over, it looked like the ingredients were building. But even we've been on the optimistic end, were very surprised with the magnitude of the fiscal shift that was announced. From my perspective, it's the biggest shift in fiscal policy I've seen in my career, both in terms of magnitude and pace. And this has huge consequences for both growth, the ECB, and even Europe's strategic autonomy versus the US. So that is one component, and I would say the policy is increasingly shifting to be cyclically relevant, even in coming quarters, rather than just structurally relevant. And then on the flip side, you have a situation in the US where tariff policy is taking place in such a haphazard way it ends up creating self-inflicted damage to the US economy. I think that is one reason why Fed expectations and US yields are coming down. And the broader fiscal picture remains very murky. So we have a situation which is the complete opposite from what I personally would have expected at the start of the year. But when the facts change, we change our minds. And that's what's happened over the last few weeks.
So, George, let's talk about a couple of things. Let's talk about this first. On Wall Street, as you know, there are certain phrases that scare people. One of them is, this time is different. George, why is this time so different? Why should we really believe this is happening?
I think the first reason is it's now been announced. It has cross-party support. What I found the most interesting in Mertz's statements yesterday is he used the phrase, whatever it takes. But take note, it wasn't used in German, it was in English. And it was also posted on X, on his feed. And this is a very conscious message by the Chancellor-in-Waiting of wanting to reflect on what Draghi did and sending the same message for Germany. So it does have to go through parliamentary approval. We have a fairly high degree of confidence that it will. And once it does, we are speaking of immense amounts in terms of orders of magnitude. So you discussed earlier on the show the shift around the big infrastructure fund, the potential unlimited defense spending. I would also add they're going to reform the debt brake to allow a greater degree of fiscal spend at the state level, which provides cyclical stimulus as well. So if you add all of these things up, they are going to have a very material economic impact on Germany, and by extension, I think, the whole of Europe.
George, if you have so much conviction, why is your Euro USD target 110? Why isn't it higher?
That's a great question. I would say one step at a time. Every day we're seeing news flow that would usually take years or even decades to potentially feed through. So I would say what we need to argue for an even weaker dollar is for persistent economic weakness in the US. That's going to be a function of what happens from the administration over coming weeks. Do we see a reversal in the tariff policy? So I think there's still a tremendous degree of uncertainty on the US side and how much the recent weakness continues. It is a function of fiscal in the US and tariff. And then there is some execution risk, as we discussed around Europe. But it is the first step, 110, and we're very open-minded in terms of how we think about the outlook.
I think we've got to be open-minded about everything right now, George, including the United States. So let's finish on the US. You mentioned the US side of things. A question we've gone back to repeatedly on this program ever since the election. Do you see a policy mix that attracts capital to the United States or a policy mix that pushes it away? I asked that question earlier this morning. George, what's your call on that now, and has it changed?
Well, I think it's becoming a bit more ambivalent over the last couple of months. And I would say there's two drivers around that. One just relates to the policy mix itself. It's less about the specifics, and it's almost about the lack of specifics and the uncertainty around the reaction function. Now, if you're putting 20-25% tariffs on half of your imports and you don't know, are they going to be there the next day? Are they going to be removed? That is naturally going to be creating economic uncertainty. And I think we're seeing that materialize, and that is why US risk markets are underperforming. So that's one aspect. The second one is broader, and you could even call it a positive, but to the extent that President Trump is encouraging other countries to build strategic autonomy and is encouraging other countries to spend, all of a sudden, you have an investment thesis potentially for Europe. Now, that's the more positive angle. The more negative angle is the policy uncertainty in the US itself, which I think desperately needs a bit more clarity.
Hey, George, appreciate your time. George Saravelis there of Deutsche Bank, looking for 110 on euro dollar. Not so long ago, maybe a month or two, we were talking about parity maybe dropping below that level. The last 2 days, Lisa, this is not what people thought would happen. This wasn't in the playbook. Tariffs on, dollar weaker for 3 consecutive sessions.
There was a belief that it would make the U.S. stronger and it would make everybody else weaker. That narrative has shifted, and the most interesting aspect is that the U.S. market is losing faith that tariffs will actually cause the United States economy to get stronger, and instead is projecting more weakness at the same time that you're seeing actual fiscal spending, or the potential for it, in Germany.
This time is different, we're told, out of Europe. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. President Donald Trump has called for ending the bipartisan $52 billion semiconductor subsidy program, the CHIPS Act, which spurred over $400 billion in investments from companies like TSMC and Intel. Trump argued that tariffs would achieve the same outcome as the CHIPS Act. An investor group led by BlackRock agreed to buy a controlling stake in some Panama ports. C.K. Hutchinson said that it would receive more than $19 billion from the sale. It's the largest infrastructure deal in BlackRock's history and is a win for President Trump, who had voiced concerns about Chinese influence in the Panama Canal. Elsewhere, China has set an economic growth goal of around 5% for 2025 and a fiscal deficit target of 9.9% to GDP. That is the highest on record. The government plans to boost consumption with a focus on benefiting people's lives, and will sell a special bond to fund public spending on infrastructure and other areas. And that's your brief, John.
Hey, Danny, thank you. More from Danny in about 30 minutes. Up next on the program, the president celebrates a bond market rally.
We will defeat inflation, bring down mortgage rates, lower car payments and grocery prices, protect our seniors, and put more money in the pockets of American families. And today, interest rates took a beautiful drop, big, beautiful drop. It's about time.
Bob Michael at JP Morgan Asset Management joins us next from New York. You're watching Bloomberg Surveillance.
In case you missed it, on Bloomberg Technology.
It's incredibly aggressive, the timeline to manufacture the first phase of this site and then start production mid-2026. How big a factor was that timeline in Ohio's selection, Palmer?
It has to be this fast because we don't have time for business as usual. The types of threats that the United States is facing, that our allies around the world are facing, the fact that we are predicted to run out of munitions within the first 8 days of a potential conflict with China mean that we need to hyper-scale our manufacturing. We are on a path to being a publicly traded company. I think that's an important thing. I want us to be accessible to the American public. I think that it's good for people to be able to invest in American defense companies, not for them to just remain private forever. I'll take an ideological stand there. I think that is a good thing for the country. It's good for us. It's good for our customer. As for when that happens, it's hard to say.
Don't miss Bloomberg Technology, live every weekday.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Equities bouncing back this morning on the prospect of a trade compromise between the United States, Canada and Mexico. Equity futures on the S&P positive by 0.6%, up by 0.75% on the Nasdaq. On a Russell, up by 1 percentage point. Under surveillance this morning, the president celebrates a bond market rally.
We will defeat inflation, bring down mortgage rates, lower car payments and grocery prices, protect our seniors, and put more money in the pockets of American families. And today, interest rates took a beautiful drop, big, beautiful drop. It's about time. And in the near future, I want to do what has not been done in 24 years, balance the federal budget. We're going to balance it.
Here's the latest this morning. The president embracing a big, beautiful drop in interest rates as the White House appears to show more interest in the favorable bond market moves rather than a stumbling equity market. Joining us now to discuss JP Morgan Asset Management's Bob Michael. Bob, good morning.
Good morning.
We've got a lot to get through. We'll get to Europe quickly, but I want to start with the United States. Does it bring you comfort that the White House seems to be more interested in your bond market than the equity market?
It does to some extent. I think bond investors are going to go through a period of discomfort, to borrow a phrase from the president, where probably yields have gotten a little ahead of themselves. So, you know, any kind of backup to the mid-fours looks like a good level for us to get in.
So you're not a buyer here?
Not right now.
Are you a buyer of bonds here? Can we bring up the curve? Let's get back to the German curve. 2-year, 10-year, 30-year. Double-digit move we're seeing over in Germany off the back of the prospect of a lot more supply. The 10-year up by 20 basis points. Where do you stand on Europe now?
I think you're looking at steeper curves in Europe. I think you're going to see a lot of issuance. They've thrown fiscal austerity to the side. They've looked at what's going on in China and the U.S., and they want to join the party, and they're going to. I still see the ECB bringing rates down towards 2%, but I think with the amount of supply that's potentially coming in Germany, you're going to drift up towards 3%. I think that's fantastic for bond investors. Again, discomfort near term, but the ability to have a bond market that has yield to it and that's durable, fantastic.
There's a fantastic bond market for investors, and there are fantastic bond markets for traders. A fantastic bond market for investors is one where there's actual coupon, there's actual yield. A fantastic bond for traders, a bond market for traders, is when yields are going down. Is that move over? Is it not any longer a fantastic market for traders?
I think there's potential for yield to go down in the front end of curves. I think central banks, whether it's the ECB or the Fed, are looking for that opportunity to bring yields down a little bit, get closer to what they perceive is neutral. But I think the long end is going to stay about where it is. We're having conversations every day with plan sponsors who want to get into this bond market. They're looking at it as the anchor in the storm. They like the fact they can buy the U.S. aggregate bond market at a yield of close to 5%. They're looking to bring money out of cash and out of risk assets, whether it's privates or equities, and go into the market. Fantastic.
You said this bond market. Are you talking about the United States or developed markets more broadly at a time where we were just talking with a number of guests, Peter Scheer among them, saying maybe Europe is going to draw capital away from the United States?
I think it's all bond markets. I think when you look at what equities have done, they've become lopsided in terms of portfolio allocations. The plans that we're talking to are looking to do some rebalancing, and they're embracing yields where they are. As I said, I met with a plan yesterday. I met with them 5 years ago. The aggregate bond market was yielding 2.25%. They didn't invest. Now today, they've won. Yields have doubled from where they are. They're coming in, and we're hearing that everywhere from every channel around the world.
You said that you think that yields on the long end are probably where they're going to stay, at least in the United States. They're not going to go significantly lower. Do you see them going significantly higher?
No, I think you're stuck in the fours. We're probably a buyer in the mid-fours because with another round of tariffs coming and the blizzard of policies that come out of Washington, there's going to be a lot of volatility, and there may be a period where people run to treasuries and you get down towards 3.90 or 4%. But I think we're going to look back on 2025, and they're going to have spent almost all of their time either side of 4.5%.
A period where we run to treasuries. Let's build on that. Could we be going into a period where we run away from dollar-denominated assets? Certainly not my view, but a view that is out there. People who believe that maybe the policy mix of the United States at the moment pushes capital away. We've heard that a few times already this morning. Where do you stand on that call?
It should be your view, John. I think dollar exceptionalism has ended this week. We've done a lot of work. We've gone back and we've looked at Trump version 1, and we see a similar path where the dollar peaks early, a couple months into the term, and then tends to come off. We've talked about the dollar being overvalued for a year or so now, and I think now you're looking at fiscal spend in China, you're looking at fiscal spend across Europe, and we're looking at, we didn't talk about Japan, we're looking at close to 1.5% 10-year JGB yields. I don't even remember when I last saw that.
When you say a period of dollar exceptionalism is over, do you mean for the currency specifically, or do you mean the dollar long that we've built up over the last decade in dollar-denominated assets across fixed income and equities alike? Would you go that far?
Yes, I would go that far. I think everyone has talked about how expensive U.S. markets have gotten relative to non-U.S. markets, but nobody wanted to step in front of the steamroller. And now the steamroller's rolling the other way. And I think you're going to see this flow out of dollar-denominated assets, and I think the dollar comes off from where it is. I think that process is underway.
Substantially, if you're correct. Lisa, these are huge changes potentially for financial markets worldwide.
I just wonder how much it reduces some of the flows into U.S. risk markets, and I wonder how much that gives more fuel to what we've already seen, particularly with some of the most consensus bets, which is the technology firms.
All these things we've been asking for such a long time. China needs to do more deficit spending. Headline overnight, you're going to get it. Germany needs to invest more in infrastructure, in defense. Headlines in the last 24 hours, you're going to get it. Deutsche Bank's George Saravelos talked about it about 20 minutes ago, put it perfectly. You cannot overstate the changes we're seeing in the global economy. I know a lot of people sit here in the media every single day and say, big week, I'm guilty of it. Big week coming up, payrolls Friday. Forget payrolls. Forget the data. These are massive policy shifts.
This is the time, and this is something Jim Reed says every morning, that years happen in the period of days. And we've seen that again and again, reshifting expectations. There's a lot to be determined. But my big question is how far does this go in rearranging trade lines? Kind of what Donald Trump wanted. So this is the new world.
Payroll's still important. Friday, 8:30 Eastern time, all right? Don't forget payroll, so take that back. Bob Michael at JP Morgan Asset Management. Bob, some big calls. Appreciate your time, sir. Thank you. Up next on the program, Dan Greenhouse of Solos Alternative Asset Management, Monica Guerra of Morgan Stanley, Congressman French Hill of Arkansas, Ed Yardeni of Yardeni Research. Then later, in about an hour from now, the Commerce Secretary, Howard Lutnick from New York. This is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
In recent years, you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well, that was started in 1977, when by then I had a little research station, and 4 of my students were kidnapped, and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's, you know, we've got 27 Jane Goodall Institutes around the world. And then I realized at some point that people living, the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to diseases like Ebola and HIV from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation won't work.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Asia is at the forefront of some of the world's biggest stories. I'm Sherian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
We'll have to see how these tariffs as they resonate throughout the economy.
The data in hand tell us it's payback, not a turning point, but it's hard to look forward and say everything's okay.
When you start to see the economic data, kind of wobble a little bit, now you're talking about how firm is that foundation.
The mechanism where these tariffs may have an effect on GDP or in the economy as well as earnings will probably come in faster into the market than it was back in 2018.
Ultimately, we think the Fed's going to cut. We ultimately think the tariffs will probably come back, but be repealed.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance starts right now, so let's start stateside with your scores. Equity futures on the S&P 500 bouncing from a two-day losing streak on the S&P. We're higher by about 1/3 of 1%. On the Nasdaq, up by 0.5. On a Russell, up by 3/4 of 1%. On a prospect, the potential for a trade compromise between the United States, Canada, and Mexico. If you get to the German bond market, no compromise. Over in Germany, the prospect of a fiscal regime shift. Yields are higher by close to 20 basis points on a German 10-year. We're pushing 270. And a change in China. A growth target of 5% and more deficit spending. Some big shifts internationally.
On the surface, it sounds like the United States is at least speaking a tone that they're going to reduce the fiscal overhang, the deficit, while other countries, in particular Germany and China, are talking about increasing their spending at a time where a lot of people have been calling for it. What actually gets done remains to be seen. That said, we're looking at a complete 180 in terms of where the growth is going to come from, where the fiscal impulse is going to come from, and maybe where the capital flows are going to go.
Already had quite a headline in the last 20 minutes or so. It came from Bob Michael, the CIO of JP Morgan Asset Management. The end of dollar dominance. In his words, the end of U.S. exceptionalism. And not just for the currency, but for all those dollar-denominated assets that have performed so well, particularly in the equity market over the past decade.
So how far does this go? And that remains to be seen. I think we all don't know what's going to happen in terms of how many of these plans are actually going to go into effect. But what we're hearing right now are a whole host of policies out of the White House that people don't know how to plan around because we're not sure which ones are going to go on, which ones aren't going to go on. And right now, the market is voting and saying this is probably going to hamper growth, while other countries are saying, let's boost growth, let's boost defense, let's boost our spending.
The strategic anchor for the equity bulls stateside remains the same. In 12 months, when you look back 12 months, you will see a policy mix that is still pro-growth and pro-risk. We can only judge this journey as we go by the economic data that comes in. The sentiment data hasn't been great. The survey data hasn't been great. ISM manufacturing was weak. Later on this morning, 10 a.m. Eastern time, I think, ISM services. Will that confirm the weakness going into payrolls on Friday?
At a time when we're starting to get commentary from a whole host of chief executive officers, Best Buy, we heard from Target, saying that already they're seeing some consumer behavior change on the heels of this uncertainty, and they're saying that they're going to pass along some of the higher prices on the heels of tariffs to their consumers in the coming days. That was the Best Buy CEO. You take a look at this mix, and you wonder, maybe we're getting too far with this weakness story. It's only been 6 weeks. It's hard to remember that, and I keep reminding myself. That said, going forward, it turns all of the consensus trades, you've mentioned this before, on their head at a time when there were some very heavy longs that are getting upended.
Those consensus trades have been beaten up all right the first few months of 2025. Equity futures this morning positive by 0.4%. Coming up, Dan Greenhouse of Solis Alternative Asset Management on a wild day for stocks. Monica Guerra of Morgan Stanley on President Trump's joint address to Congress, and Congressman French Hill as Trump warns of economic discomfort from tariffs. We begin this hour with stocks looking to snap a two-day losing streak as Secretary Lutnick hints at a possible tariff compromise. Dan Greenhouse of Solis Alternative Asset Management writing, I'm still optimistic in general, but have felt and still feel we're in a holding pattern for risk assets until at least the Fed meeting on March 19th, but perhaps even longer. Dan joins us now for more. Dan, good morning.
Good morning to you, sir.
What's special about March 19th? Why the Fed meeting?
Well, I think my point back at the when the inflation data had come out, that we were unsure of how the Fed would respond to this. This was before a lot of the tariff stuff had really exploded. And I thought, well, listen, we've had a really good run in asset prices here, both equity and credit, among others. And so it's not out of the realm of possibility that we digest this and get some guidance from the Fed and how they think about the inflation backdrop. And then, of course, the situation has been compounded in the last couple of days by the tariff story.
We mentioned the strategic anchor for bulls here in the United States, and that's the policy mix of the overall platform, not just trade, but the complete picture is still pro-growth, still pro-risk. Has that changed?
No, I mean, the problem always was and remains that the positive parts of the incoming administration are going to take longer to implement than the more deleterious policies. So out of the gate, you have some immigration curbs, if that's a problem for you, some tariffs, if that's a problem for you, and the deregulation, if you will, or the more permissive M&A environment that everyone's hoping for, the extension of the tax cuts or perhaps some additional tax cuts, tax on tips, et cetera. That's going to take many, many months, if not even longer, to work out. And so what the market is wrestling with now, again, on the heels of a really terrific rally, are some of those more deleterious policy outcomes that are resulting in something of a correction in stocks, which we're experiencing in credit as well. And I don't think it's super unhealthy. But with that said, those other options or those other policies are still coming down the pike. The economy is still holding up fairly well, although obviously Q1 is looking worse by the day. So I think you still have to remain optimistic in the larger sense while understanding we're undergoing something of a correction now, which is not unusual.
You came in this morning, I'm going to tip your hand.
Sure.
You said, today's going to be easy. You're going to ask me questions, and I'm going to say, I don't know, I don't know, I don't know, because that's pretty much what everybody's doing.
You took my joke.
Okay, well, I took your joke because I wanted to build on it and ask you, doesn't that have an effect? Doesn't that have a ramification, this level of uncertainty that means that all the companies that are planning M&A don't know what kind of structure they're going to be looking at when they actually go to transact those deals?
Well, yes and no on the M&A front. I mean, M&A transactions are long-lived deal-making processes. So I think a lot of people are going to look through this and say, okay, where do we expect the old Warren Buffett line, I'm betting on America type of. So the M&A story, I think, is going to be there. Obviously, we have to get a handle on how permissive relative to the previous administration, the current administration is. And as I always remind everybody, there was J.D. Vance did say Lena Khan was his favorite. And I think the idea that there was going to be unfettered M&A activity allowed was probably always a little optimistic. But that said, in the immediate term, of course, what's happening right now chills investment, chills optimistic risk-taking. And you see this playing out in equity and credit. Again, it comes on the heels of a terrific rally for the third or fourth time, because I think it's important. If something like this happens at the bottom of 09, it's different than if it happens now.
You're saying the pro-growth policies are going to come down the pike. Which pro-growth policies are you talking about at a time where they're trying to pass a budget that extends the tax cuts, but doesn't really have any provisions in it for some of what Donald Trump talked about last night, whether it was no tax on tips, no tax on Social Security, and no tax on a host of other different issues?
So, listen, I think this is a really complicated conversation. In the immediate, listen, if you're going to balance the budget in a year, that's not pro-growth. Whatever one feels about the level of federal spending, or the worthiness of federal spending, removing that much fiscal expenditures from the economy in a short term is not going to be pro-growth. It might be down the road, but it's not going to be in the short term. What I'm looking forward to is that more permissive risk-taking environment, is the extension of the tax cuts so that uncertainty gets taken off the table. Perhaps you get some other fiscal expenditures as well. The immediate budget deficit is going to expand. All of that together with the pro-America attitude of the administration, which matters for a lot of risk-taking, both among individual investors and companies, is being overshadowed right now by the uncertainty around the tariff debate. And as we saw with Howard Lutnick, Commerce Secretary Lutnick last night, that might, an hour from now, might not be the case anymore. So it's not that I'm looking forward to no tax on tips revolutionizing the tax landscape, or or putting someone in place at DOJ or FTC that's going to be incredibly different. It's the totality of the attitude of the incoming administration, both in terms of how it presents itself and its policies that it's putting in place, that on balance is going to be more optimistic and more pro-America and risk-taking than the previous administration. And that's not to say that that automatically equals higher stock prices or lower credit spreads, but on balance, it equals higher stock prices and lower credit spreads. And as long as the economy continues to hold up, I think that's the type of environment in which you want to be positive on risk assets.
Well, that's the key part, as long as the economy continues to hold up. So I sit in a similar seat. I want the president to succeed. I think everyone should want the president to succeed, regardless of who the president is and what political party they bat for. The thing I worry about, and I can share it, and I'm happy to, sentiment was sky high into 25. And we all said repeatedly, I want to see that confidence turn into hiring, into investment decisions. My fear now is that by the time we get to tax policy, something bad's happened in the economy. So what are we looking at the moment? We're looking at the cumulative impact of persistent uncertainty around the trade story.
Yep.
You can't say it's 25% on our neighbours one day, come out a couple of hours later and say we might be dropping them. I've got no idea what the Commerce Secretary says in 40, 50 minutes' time on this programme. I look forward to hearing what he's got to say. There is some damage done by that. Every time I hear from a CEO at the moment, particularly from the banks, they say wait and see. We're in wait and see mode. Wait and see mode, if you're choosing to do nothing, you're choosing to do something, and that's nothing. As opposed to hiring people, investing, getting deals done. I just wonder where we'll be by the time we get to the summer, by the time we get to the end of the year, and we're talking about dropping taxes, maybe the corporate tax rate down to 15%. The soft data's already softer.
Yep.
Can't debate that. I need to work out from you and your opinion whether you think the hard data is going to weaken as well between now and then, because that unleashes some very different forces.
Of course. And listen, the soft data, the survey data, has weakened repeatedly over the last couple of years, even before COVID. In a way, the hard data has not.
We've seen head fakes before.
For sure. Last summer, when the S&P fell, call it 10% or something like that, the BOJ was hiking rates. There was worry about a recession. Jobs numbers, that was the first time they started dipping into double digits. You had a meaningful sell-off at the end of 23. I think it was maybe more than 10% of the S&P in that time for similar reasons, not the BOJ hiking, but economic worries. And we're going through one of those now. Do I think the hard data is going to roll over? The answer is no. Now, Anna Wong, Bloomberg economist, wrote about the risk to the jobs report on Friday owing to the lack of hiring and layoffs in the federal level. What I don't know, and we're going to find out, is if that number, and she posits that it's within her confidence interval that the number could be negative, and I've seen one or two other people on the street speculate as well, if you have a bad number on Friday, but it's 40,000, but the private sector added 90,000 or 120, how does the market deal with that? Because there are many people who are going to say, well, we're laying off unproductive federal workers. That's going to reduce the budget deficit. Positive for yields, which have already come down. That's good for risk assets. I don't know the degree to which the market is going to weigh job losses in the federal level, which appears to be something that we're going to find out on Friday, if not over the next few months.
And that could be an important test, Lisa, for this market in the coming weeks and months.
Yeah, how much people look at the details of some of these labor market reports to really understand exactly what's going on. I'm just thinking, as you were talking, and something that we're grappling with, can you put this sort of sequential story on hold as sort of, okay, we'll do all the bad stuff up front and then the good stuff at the end, and really expect the stuff up front to have no consequence when it isn't necessarily that the plan is coming out, it's the uncertainty around the plan. And I think that that's going to be a continually theme.
It's journey versus destination. I think the destination still could be a very good one. Just the journey has started, and we can only look at the data so far to guide us, and the data so far hasn't been phenomenal.
Yeah, the journey, though, this is sort of the classic life story, right? The journey can change you. And so you might not be the same person when you end up at that destination. And so there is a question of how it sort of leaves its mark. And I think that is what we're all grappling with.
Dan's got to go. We'll continue the therapy session. Commercial break.
Dan does not have to go. Dan wants to talk about oil prices.
Do you want a final word on crude?
You just have to. Oil was just $80. It's now under $7.
Big drop. Rates are down too.
The rates are down. The inflation story is not just tariffs on goods. The first administration, we saw goods prices went up. Overall inflation sort of stagnated around 2%. It's a different environment now for sure, but oil prices don't get enough attention in this conversation.
They're getting attention right now. Crude's down, rates are down. You don't think it's just about economic growth?
Well, it's part about economic growth, but it's also OPEC is unwinding some of their supply constraints. And listen, the president has said, I want lower oil prices. And for people who believe in this president and his ability to get deals done, so far he's $10 in. I don't think he's going to be happy until it's 50.
The Treasury Secretary sat in your seat and said basically the same thing. Need to bring energy prices down, need to get inflation lower, need to get interest rates down, bond yields lower, and then we can talk about doing a lot more on the fiscal side of things.
And I always say the first step to being Treasury Secretary is sitting in the Treasury Secretary's seat. So we're on the way, step one.
Yeah, well, we'll see. I mean, these are the ideas behind can you generate growth and how do you create a more financially fiscally viable structure. Is this by design? This is what they're targeting, lower yields and lower oil prices, and that's what they're getting.
They're certainly celebrating it. Dan Greenhouse of Solace Alternative Asset Management. Dan, thank you.
Thank you, guys.
Good to see you. Thank you, sir.
Always a pleasure.
Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Breaking moments ago from the Financial Times, the U.S. has cut off intelligence sharing with Kyiv. Two officials confirmed with the FT that Washington had frozen the channels with Ukraine, a move that could hamper Ukraine's ability to identify and strike Russian military targets. It follows President Trump's Monday decision to suspend military aid to Ukraine. Democratic Congressman Al Green of Texas was removed from the House chamber during President Trump's joint address to Congress last night. Green shouted and shook his cane in protest. Meanwhile, Senator Alyssa Slotkin of Michigan presented the Dems' response.
President Trump is trying to deliver an unprecedented giveaway to his billionaire friends. He's on the hunt to find trillions of dollars to pass along to the wealthiest in America. And to do that, he's going to make you pay in every part of your life.
Slotkin went on to argue that Trump's tariffs will hurt U.S. manufacturing, farming, raise costs, and potentially lead to a recession. Canadian Prime Minister Justin Trudeau says that President Trump's tariffs are an attempt to destroy Canada's economy so he can annex the country. Trudeau said that his government will file a dispute with the World Trade Organization and the free trade agreement between the U.S., Mexico, and Canada. Canada earlier hit back with levies targeting about $21 billion worth of U.S. goods, which it says will be expanded if U.S. tariffs stay in place. And that's your brief. John.
Danny, thank you. More from Danny in about 30 minutes' time. Up next on the program, the Trump trade agenda.
The next phase of our plan to deliver the greatest economy in history is for this Congress to pass tax cuts for everybody. The tariffs are about making America rich again and making America great again, and it's happening, and it will happen rather quickly. There'll be a little disturbance, but we're okay with that.
We'll talk about that disturbance in just a moment with Monica Guerra of Morgan Stanley from New York City this morning. Good morning.
there is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
So we've got a bounce this morning. We're up by a third of 1%. In about 50 minutes from now, don't miss this, a conversation with the Commerce Secretary, Howard Lutnick, about trade and the potential for a compromise between the United States, Canada and Mexico. Off the back of that potential, equity futures positive by a quarter of 1% on the S&P 500. Bond yields a little bit lower. We're down 2 basis points, the 10-year 4.22. And a surveillance this morning, the Trump trade agenda.
For every one new regulation, 10 old regulations must be eliminated. The next phase of our plan to deliver the greatest economy in history is for this Congress to pass tax cuts for everybody. I have also imposed a 25% tariff on foreign aluminum, copper, lumber, and steel. Tariffs are about making America rich again and making America great again, and it's happening, and it will happen rather quickly. There'll be a little disturbance, but we're okay with that.
So here's the latest this morning. President Donald Trump reiterating his America First agenda in his joint address to Congress. Trump pushing for tax cuts and eliminating the CHIPS Act while acknowledging that tariffs will bring some economic disturbance. Monica Guerra of Morgan Stanley writing the market could be undercounting the long-term impact of tariffs because of policy uncertainty. Monica joins us now for more. Monica, good morning.
Good morning.
I'm so pleased you went there because I think this is so important. Whether the tariffs are 25, 20, 15 or 10, I think the business community just wants to know and have certainty and start to plan for the next year, several years. That uncertainty, that volatility of the policy itself, how much damage could we see off the back of that?
The policy itself, I think, could have significant implications depending on the different industries that it's impacting. When we're thinking about the policy uncertainty piece, not essentially undercounting potential impacts, it's what happens next. Now with Mexico and Canada, we spoke last week. We thought that something like this might happen, right? That the tariffs could be implemented. They could be renegotiated. You have USMCA potentially pulled forward into 2025. That situation, our relationship with our neighbors, is incredibly dynamic. It's what happens in April. And I think that staying on top of potential tariff risk is important.
There is a question about who President Trump is speaking to, because markets had just expected, heading into this year, that he would be catering to them on some level, that he'd be looking for market approval. It seems like that's not the case, with a little bit of disturbance being just fine. Do we have a sense of where President Trump is looking to sort of get that approval?
So the little bit of disturbance piece, I think, is key, because the sell-off we saw was, just in the, the range of 2.5 on the day on the 2nd, right, when the tariffs were implemented. You saw, the biggest hits, right, to tech and energy, given the types of tariffs that were being, proposed. Now, what's important here is that that's not this big market downturn. If you had a greater correction than that was prolonged, that I think would get the president's attention. But a point in time, momentary response is expected, and something that I think, he's saying we can all live with, that markets are rebounding. They're looking to the potential of his negotiating tactics long term.
You aren't seeing, though, deals being announced. You actually saw M&A volumes fall pretty significantly in February. We've talked to a number of executives saying we just don't have the certainty, and to John's point, that uncertainty drags on growth, and you're starting to see that in some of the data. In your conversations with people in Washington, D.C., is President Trump and his cabinet concerned about that level of uncertainty and some of the soft data rolling over?
No, I don't think they're concerned. Now, what we've seen as far as their strategy in Trump 1.0, it was the growth policies first and then tariffs second. This is the reverse. They're intentionally doing this. They're coming in at a point of extreme geopolitical tension and conflict, so they're looking to address that, essentially reinforce the America First agenda, and then hoping that off the back of that, the growth policies pick up. So when you're thinking about, this is where budget and tax come in, that if you get the cuts, if you get additional cuts to corporates, they're hoping that that's going to create tailwinds through 2026, because that's when they go into effect. So 2025 is a restaging, resetting, resizing year. It's going to be choppy. This is something we talk to our clients about regularly, that this is a bumpy year, that you have to see through it. And that's what I think the Trump administration they're looking at too, is what happens in 2026 and then legacy going forward.
Lisa mentioned this earlier. I think it's an important point regarding taxes. 2017, we were talking about tax cuts. 2025 into 26, we're talking about the extension of tax cuts. How different is that? And will we get additional cuts beyond just the extension of what we did back in 17, 18?
So they are different. If you're looking at it from a budgeting perspective, you have to start from where we are now. What would be the impact long term? So if you extend the tax cuts as is, that would add $4 trillion just off the bat to the deficit. Now, if you get additional cuts, it's likely to be, to Social Security, to, no tax on tips, those types of give-backs to the individual. But more importantly, on the corporate side, Trump has said he wants corporate income tax top line as low as 15%. So that is, significantly stimulative in the long run when you're thinking about corporate America.
He wants 15 with a U.S. production element attached to it.
Yes.
Do we really understand what that's going to look like and how it works?
I don't, especially because I think that there is a component here that people are missing, is that you have to pay for those tax cuts somehow. Tariffs is one way that they're looking to do that, right, through that external revenue service, passing through funding, right, through an accounting adjustment. The other thing that people aren't looking at is the potential for increased corporate taxes on foreign revenues. So this is something they did in 2017. It's, I would say, an easy, low-hanging fruit if they're looking to raise taxes, because it speaks to not only trying to re-incentivize businesses to bring their production, manufacturing, sales home, right? But it also helps offset any top-line corporate income tax reduction.
And you need the tax picture to really fully understand the overall effort alongside the trade effort.
So if, for example, some of the auto manufacturers had to pay 25% tax on parts from Mexico and Canada, it would be offset with a 15% tax rate, top-line tax rate that would come later on. It's in theory.
Yeah. That's how it all comes together.
Right, but then the sequencing does matter.
Monica.
Sequencing matters, yes.
We've got to go. Appreciate your time, as always. Thank you. Monica Guerra there of Morgan Stanley. Up next, Congressman French Hill, as President Trump warns of economic discomfort still ahead.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people,
the tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
30 minutes from now, must watch. Live on Bloomberg Surveillance, Howard Lutnick, the Commerce Secretary, on the potential for a compromise between the United States, Canada, and Mexico. And that potential, according to the Commerce Secretary himself, unlocking some gains in this equity market. Equity futures bouncing this morning, 2 hours away from the cash open, higher by 1/3 of 1% on the S&P, on the Nasdaq up by 0.5, on the Russell up by 0.8. With a few hours until that cash open, let's get some morning movers for you. Here's Manus Cronny with more. Morning, Manus.
Jonathan, that's manifest in all the order names, but I picked off Stellantis. Of course, Commerce Secretary said it's not a pause. Well, what is the recalibration? That's going to be the critical thing, because 4% of U.S. autos production is now tariffed at 25%. Stellantis garners even more support from the European Union relaxing, you got it, Jonathan, CO2 emissions. You've touched on it several times, stepping back from some of the bars that they have set. Let's see what Commerce Secretary has got to say, because profits will be under pressure. Tesla. Politics and production. Let's deal with the production. Sales in Germany fall 76% in February. EV registrations rise 31% in Europe. In the first 2 months of the year, down 71%. So this is about recalibrating production of Model Y and at the same time the SUV. But I'll leave you with a kicker. In the UK, their sales rise by 11%. So it's not all political. CrowdStrike. You might have had an interruption in your flight last year. You may remember the security software firm were behind it. That costs $60 million in 2024. They told us in the latest quarter, that's another $21 million. CEO, you gotta love it. Everyone loves a comeback story. Not at the moment. John.
That story feels like a decade ago. A lot's changed since then. Manus Cronny, thank you, sir. Some of the movers to watch going into the opening bell on our radar this morning. Commerce Secretary Howard Lutnick hinting at a possible tariff compromise with Canada and Mexico that could come as soon as today, saying tariffs would not be fully rolled back, but will land, quote, somewhere in the middle.
This is where people are waiting for, and this is the hope that we're seeing priced into markets. It is curious that last night, President Trump, did not talk about the idea of rolling back tariffs. In fact, he just doubled down and talked about how tariffs are going to make the United States rich again. So I'm curious about how this goes forward at a time where there's a real fissure between some of the allies in the United States, and a lot of people are waiting for April 2nd to really be the reassessment date when retaliatory tariffs go into effect.
The great irony of that is pushing the allies to do things that are good for them. We've talked a lot about Europe and Germany potentially spending a whole lot more. China overnight setting an economic goal of about 5% for growth for 2025. The country also announcing its highest fiscal deficit target in over 3 decades. Those kind of moves were the kind of moves that people have been talking about for years and hoping these countries, China and Germany, would go through with.
With China, it was interesting because they had their annual confab of leaders, and they came out talking about trying to boost consumption among just the rank-and-file Chinese residents. That was interesting, a notable shift from previous iterations where they didn't want to really give direct subsidies to individuals. Europe is really the big story this morning to me. This is probably the biggest shift I could possibly imagine. The always fiscally restrained Germany coming out. And let's just emphasize, it isn't just $500 billion, 500 billion euros for infrastructure spending. It is an unlimited checkbook for military spending, defense spending. This is whatever it takes when it comes to beefing up exactly what President Trump wanted them to beef up.
If they can get it through Parliament, and a lot of people in Europe, experts on this, tell us they can, and we'll see. But to your point, President Trump wanted the Germans to spend more on defense. They're spending more on defense. Secretary Bessent wanted the Chinese to rebalance their economy. Based on the moves last night, they're pushing to rebalance their economy. We're moving in the right direction.
A lot of people in markets seem to be suggesting, be careful what you wish for. And I think that there is this issue, if you start to see capital being sucked out of the United States, will it be a positive with respect to being able to rebuild industries in the United States, or will it leave a hole in asset prices and potentially some of the investments that were also part of the plan? And that part of the plan, we still need to see.
Yeah, this won't address everything. In China, there's still big problems with imbalances, and in Europe too. You're not going to shift European culture overnight, even with a plan that big from Germany, but this is the first step. It's a start.
Which is the reason why people are reshifting their entire perspective. The idea that George Saravello said overnight his view changed on the euro. He was bullish now on the euro. And it just sort of was a matter of how far he could take it.
He's got no choice. It's hard to be bearish right now. You've got a 23 basis point move on a 10-year yield over in Germany this morning. We're up by 13 at the front end of the curve, and a euro stronger by 0.75%, around 107. Elsewhere, BlackRock striking a $19 billion deal to place Panama Canal ports under American control. President Trump taking a victory lap in his joint address to Congress last night.
To further enhance our national security, my administration will be reclaiming the Panama Canal, and we've already started doing it. Just today, a large American company announced they are buying both ports around the Panama Canal and lots of other things having to do with the Panama Canal and a couple of other canals.
There's a fantastic story on the Bloomberg terminal, by the way, that I suggest you all take a look at. It's on BlackRock and on this deal. It's available on Bloomberg.com as well. Donald Trump promised on day one to seize the Panama Canal. We're taking it back, the US president declared in his inaugural address. Within weeks, Wall Street billionaire Larry Fink was on the line with the White House.
And the headline of that story is that BlackRock's Fink used a direct line to Trump in the Panama Canal deal. And that, to me, highlights how people are thinking about this administration. They're listening to what he says, and they're saying, I have a deal for you too. And I can figure out how to put $19 billion into this and then get United States ownership over a key trading infrastructure piece that the United States helped build. A real question of what else is to follow. And this is something that's interesting. These are all of the ways that people are hearing Donald Trump's speeches very differently. If they're in the private sector and they're saying, look, what can we do to take on some of those projects? So we can expect more of that.
The president had a lot to say, a 100-minute address. He also defended his tariff plan, saying America may go through a, quote, little disturbance, but tariffs are worth the economic pain. Anne-Marie joins us now from Washington for more. Anne-Marie, over to you.
Good morning, Jonathan. That's right. The president really doubling down on his tariff agenda and plan, even though he said that we could see a little bit of economic disturbance when it comes to those, really alluding to the financial markets and potentially what we're hearing from some corporate executives. And for that conversation, I'm very pleased to say we're now joined by Congressman French Hill of Arkansas, also chairman of the Financial Services Committee. Congressman, thank you so much for joining us this morning. I saw you very late last night leaving the chamber, so thank you for getting up early for us. Trump sounded committed to his plan last night when it comes to tariffs. One of your biggest employers in the state of Arkansas is Walmart, and the CFO said a couple of weeks ago that it's not going to be completely immune when it comes to tariffs. So what are you telling businesses and corporate America that are concerned with his trade policies?
Well, Anne-Marie, it's good to be with you. Well, as I've said on this show for many, many years, I think across the board tariffs in a sustained way can lead to higher prices, and they may or may not lead to measurable increases in output here. I think that's what we've seen since 2017 on the steel and aluminum tariffs that we've had imposed by the Trump administration and left in place by the Biden administration. A modest increase in production, and but no real impact in major employment. In fact, in some instances, higher prices if you were buying a washing machine, for example. So, bottom line is, I think the best use of tariffs are exactly as I hope I hear from my friend Howard Lutnick in a few minutes, that they're used for a negotiating tool to get better trade arrangements, open markets with countries. And as it relates to the USMCA, Anne-Marie, it's so important. That's about 30% of Arkansas output goes to Mexico or Canada. I believe the best way to approach this is to simply reopen the USMCA and have Canada, Mexico, and the United States continue to look at that agreement and try to improve it. For example, if you're concerned about transshipment of Chinese activity in Mexico, why not talk about the rules of origin in Canada, the U.S., and Mexico in terms of foreign components? Talk about, again, the share of North American manufacturing component. That's the way I think it's best to handle a trade between the two countries in our existing agreement, because across-the-board tariffs, as you well know, raise the cost of every automobile in the United States.
Commerce Secretary Lutnick, as you alluded to, said yesterday that there could potentially be a compromise. We'll hear from the president today. Are you hoping to hear about exemptions or carve-outs, or actually lowering the 25% rate?
Well, I would leave that to Howard's strong negotiating skills. I'm not going to try to out-negotiate either Trump or Lutnick when it comes to representing the United States. I just think that it's smart to consider all the downstream effects from tariffs and have clear objectives of what you're obtaining. You want border security, you want to remove fentanyl, you want to stop transshipment of dumped steel or aluminum from another country through Mexico or Canada into the United States. Those are all worthy objectives, but I think they can be handled through negotiation.
Trump yesterday said at the speech yesterday that they can deal with a little disturbance, alluding to the stock market pullback and potentially the concern about how this could mean passing on prices, higher prices to consumers. Do you think the president still cares about the Dow Jones Industrial Average? He didn't mention equities at all last night, but he did mention rates. Is he squarely focused now only on the 10-year yield?
I think the president's focused on bringing broad manufacturing back to the United States, and I think the United States is the single best location for foreign direct investment in the world, for all the reasons that your panel just talked about with Jonathan. Europe is not surging. Europe is slumping. And I'm glad to see that actions taken by the U.S. are encouraging maybe a change economically and militarily in Europe. I think that's terrific. And Xi Jinping's effort to, quote, take care of his economy last year was a total flop because he's not addressing consumption or long-term savings or pension plans or internal use in China. So both those economies are not where you want to invest. And where people want to invest is here in the United States with low tax rates, declining regulatory burdens, the stable dollar, our rule of law. And so I think President Trump's focused on making America great again through that process. And I think that's what he's focused on.
Congressman, I'm glad you brought up investments, because yesterday Trump called for the end of the bipartisan $52 billion chip subsidy program. Now, I know you didn't vote for it, but more than a dozen of your Republican House colleagues did. If companies already signed up for that program and decided to expend capital in the United States, should those contracts be able to go through?
I think if the money's obligated and the people are actually designing and implementing a facility here, then that's probably something that the United States should honor. It's a law signed into law by President Biden. I did not vote for it. I don't believe in industrial policy. I don't think we should be subsidizing directly with taxpayer money, using mandatory spending in the federal treasury to encourage a chip plant to come here and build when they were already coming in here to build. So that's why I didn't support that particular proposal.
I want to end on a markup you have today that's become a bit contentious in terms of politics when it comes to the overdraft rules that we saw under the Biden administration. Now, if your bill goes through, when you look at banks and their overdraft rules, they won't decrease, but there's a chance that with the Biden administration's rule that's in place, you can actually see some of those bank overdrafts decrease. You're pushing for the status quo. At a time when Americans are dealing with higher consumer prices, why not allow this rule to go through?
Well, Rohit Chopra, the director of the CFPB, is essentially the poster child of why you see the Chevron deference being rolled back. He violated the statutory authority of the CFPB in instituting this rule in the midnight rules that he passed between the election and the inauguration of President Trump. I don't support federal price controls through a mandate like this. And let's look at the reality. I spent a great deal of my business career dealing with the poorest citizens in Arkansas and the Mississippi Delta and providing banking services to them. I know how important competitive overdraft services are to them. Tim Scott grew up poor as the chairman and now the chairman of the Senate Banking Committee. He knows the value of the overdraft protection privilege for families. When you mandate this kind of a price cap, you're going to deny deposit services and overdraft privilege services to millions of low-income American families. That's why the CFPB rule is wrong. I want competition to handle that as it is today. Every customer I had at my company in the Mississippi Delta was a smart consumer of how to balance their capital needs and income needs for their family every month. And what Rohit Chopra does is take that privilege away from millions of people. And to your point about competition, what's going on, many big banks, Citibank, Capital One, they don't even charge for overdraft protection, and that's through competition, and that's what I think is the way to go. You force people out of overdraft, like Chopra would like to do. You send low-income families to the online and payday lending market, which I don't think is in their interest.
Congressman, thank you so much for your time this morning.
You bet,
really
Anne-Marie.
Appreciate it.
Great to be with you. Thanks.
Jonathan, that was, of course, French Hill, Congressman from Arkansas, also the chairman of the Financial Services Committee. At the top of that conversation, what I took away is he's expecting what he calls his friend, Howard Lutnick, a great deal maker, to come out with something today when it comes to Mexico and Canada.
Well, Congressman Hill's been a good friend of this program. Looking forward to catching up with his friend in about 15 minutes' time, live on Bloomberg Surveillance. Let's give an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. A Ukrainian official has told Bloomberg that the country is still receiving U.S. intelligence. That follows a report from the Financial Times that the U.S. had cut off intelligence sharing with Kyiv. If the channels are indeed frozen with Ukraine, it could hamper their ability to identify and strike Russian military targets. New York Fed President John Williams said that he anticipates that Trump's tariffs will contribute to inflation. Williams spoke yesterday at the Bloomberg Invest Conference in New York.
Based on what we know today, given all the uncertainties around that, I do factor in some effects of tariffs now on inflation, on prices, because I think we will see some of those effects later this year.
Williams went on to say that monetary policy is in a good place and that he doesn't see the need to change borrowing costs right away. Disney is cutting about 200 jobs across its ABC and entertainment TV networks. An internal memo seen by Bloomberg outlines cuts that mostly impact the ABC News division in New York, with production teams for ABC News Studios, 2020, and Nightline set to be consolidated. In its earnings last month, Disney's broadcast and cable TV business saw a drop in revenue and profit. And that's your brief, John.
Danny, thank you. More from Danny in about 30 minutes' time. Up next on the program, the Trump put.
Now, both the Mexicans and the Canadians were on the phone with me all day today trying to show that they'll do better. And the president's listening because he's very, very fair and very reasonable. So I think he's going to work something out with them.
Up next on the program, Ed Yardeni of Yardeni Research. Then later, at the top of the hour, 8 a.m. Eastern Time, less than 15 minutes away, the Commerce Secretary, Howard Lutnick from New York. You're watching Bloomberg TV.
In case you missed it, from Bloomberg's coverage at Davos.
Do you think there's one particular thing that you'd like
Trump to change in terms of what some people see as the over-regulation of banking in America?
I don't believe, honestly, that we should have a huge amount of deregulation for larger banks. I think that's, you look back at COVID and any crisis, big banks now are strong, are able to step in and being part of resolving issues rather than being the one that creates issues. So I wouldn't really welcome a huge wave of deregulations. What I can see is that, of course, what happened in the US doesn't mean automatically that you will see in Europe or in Switzerland or in Asia deregulation. So the fact is that US banks may become even more competitive internationally through a more benign environment.
Nobody covers Davos like Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg. In the next hour on this program, a conversation with the Commerce Secretary, Howard Lutnick, just moments away. Look out for that. A conversation following yesterday's comments from this individual that maybe we could have a compromise between the United States, Mexico, and Canada. The Commerce Secretary, Howard Lutnick, just moments away. Equity futures off the back of that potential compromise with a little bounce, up by 1/3 on the S&P, on the Nasdaq, up by 0.5. Under surveillance this morning, the Trump put.
Now, both the Mexicans and the Canadians were on the phone with me all day today trying to show that they'll do better. And the president's listening because you know he's very, very fair and very reasonable. So I think he's going to work something out with them. It's not going to be a pause, none of that pause stuff. But I think he's going to figure out, you do more, and I'll meet you in the middle some way. And we're going to probably be announcing that tomorrow.
So here's the latest this morning. Global markets eyeing signals of tariff relief after U.S. Commerce Secretary Howard Lutnick suggested there might be a trade compromise as soon as today. Ed Yardeni of Yardeni Research writes, we're not changing the 55% assigned to our base case roaring 2020 scenario, but we now see less chance of a stock market meltdown scenario and higher odds of a recession and bear market. Ed joins us now for more. So Ed, let's start there. Potential changes for you, and I stress potential. What underpins them?
Well, look, this administration changes its mind quite often, puts out some pretty extreme positions, and then waits to see what the other side will come back with, and that's what we're seeing right now with regards to the tariffs. The Treasury Secretary a few days ago said that he would welcome a situation where Canada, Mexico, and the United States had the same tariffs on China, and that would sort of create a fortress North America alliance, trade alliance versus Chinese imports. So there's, this is a very fluid situation, and as a result, my forecasts are rather fluid. But I think we'll get through this, and I think at the end of the day, we'll probably see lower tariff rates rather than higher tariff rates. But I'm a little confused about what this administration really wants. Does the president want all manufacturing in Canada and Mexico to come to the United States? If that's the case, that's a completely different and more radical view than just lowering tariffs.
Ed, you were the one who coined the Roaring 20s. You came out with projections that a lot of people dismissed as overly ambitious and overly bullish on equities, and you were right. You cite in this sort of slight, subtle shift that you had this morning that it is in reaction to the volatile nature of policymaking under President Donald Trump, not necessarily the policies themselves. How long can there be volatility in policymaking before there is a weight on the economic activity in the United States?
That's a great question. I don't really know, but my hunch is that we'll kind of come to settle down we in the markets will come to recognize that this volatility is here to stay, and we'll start to tune it out. And it all depends on how the next 6 months go. If the extreme positions wind up just being negotiating positions and deals are done, we're seeing that we're maybe back to the table with Ukraine, maybe back to the table with Canada and Mexico. You'll have your interview with Lutnick shortly. We'll see how it is. But as a forecaster, I kind of have to go. It's kind of like riding a bucking bull, right? I still think we're in a bull market, but it's not a leisurely stroll with a bull anymore. It's the bull's trying to throw us off. But I would stay on it because I think at the end of the day, the U.S. economy is going to prove resilient. As you know, there's a lot of fears that we're already falling into recession, but a lot of those indicators for January, I think, were misleading, and I think we're going to see that the economy is actually pretty strong.
Putting aside just the questions about the economy, which are big, and we shall get more data, and a lot of people are very focused on them, how much are you shifting your view about the United States as being the best place to invest at a time where suddenly we're seeing massive sea changes in the likes of Germany, suddenly expanding their spending?
Well, I think that's a great point, and I think as in your previous interview, which was great with Representative French Hill, he made the point that America's stances these days are forcing Germany to spend more on defense and loosen up their deficit brake, and they're forcing the Chinese government to spend more to stimulate the consumer. So this is actually all adding up to a pretty positive outlook for the global economy, notwithstanding that we're in a trade war. And if that's the case, then you're making a very good point that there are opportunities overseas, but they've been recognized. The Chinese markets already had a big move up, and the German markets had a big move up, but there's probably more to come.
Getting a big move up in Germany again this morning. Ed, we've got to leave it there. Ed Yardeni there of Yardeni Research on global markets. The move up in Germany, a 3% move today on the equity benchmark in Frankfurt, Germany, the DAX. And if you check out the bond market, we're talking about double-digit moves right the way through the curve. 20 basis point moves on a 10-year security over in Germany.
It raises a real question for the ECB tomorrow. How do they respond to this when they're expected to cut rates by 25 basis points? How long can they keep doing that if suddenly you have a fiscal injection?
We've had some big calls, haven't we, already this morning? We've got another hour to go. Bob Michael, the CEO of Fixed Income at JP Morgan, about 60 minutes ago, saying it's the end of dollar dominance, the end of U.S. exceptionalism.
And having a very different tone about how bullish he is on long-term yields, saying we're probably range-bound as we reset our expectations for fiscal spending.
There's a long list of very unsuccessful people who have bet against America over the last decade.
I would agree.
Let's see if that turns out well this time. Coming up, Commerce Secretary Howard Lutnick, Chuck Grom of Gordon Haskett, David Miracle of Goldman Sachs, Mike Schumacher of Wells Fargo. The third hour of Bloomberg Surveillance up next.
What legacy I would love to leave is to make sure that in my village I have infrastructure. So long when I'm gone, things are still working, then I have done my job. And if some people get inspired through my work and then try to engage themselves for their community and create something that is inspiring for everyone, I will be happy.
What's the best piece of advice you would give to someone young who wants to make a difference actually in this world? In architecture or with something else?
Wow, I'm not the right one to just do that.
I think you are.
Yeah, but with the pressure you have, and then you try to be the good one, the fancy guy, the intellectual one, I have no advice than to believe in yourself and really work hard. You know, when I started, no one would have imagined that I will be able to see my name connected with Aga Khan or Pritzker or sitting at Bloomberg to talk about sustainability, about future of sales. No, myself 5 years ago, if you told me that, I will say no. I will never imagine. So I will encourage everyone to believe in what you're doing and not try to run after the newest of the newest. Just be consistent. Just work on things that matters for you. Really, at the long term, it pays.
The countdown is on. everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
One of the very critical things is that a lot of young entrepreneurs don't realize is that when you start as an entrepreneur, you're not just building your business, which of course you are, but you're also building your organization. And most people don't realize that. And building an organization is not just about hiring people. It's about the culture, it's about the systems, the values, the mission. You know, it's about how you operate, how you do things, how you retain people, how you keep them motivated. So it's all of those things put together. And over time, you realize that, you know, a lot of effort has to go into it. And then eventually you have an organization that has a life of its own. It's, you know, and it's sometimes you look at it and you marvel and you think about, you know, how was this created? And was I the person that was behind getting this thing done?
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
When you think about all the catalysts, the risk is not quite balanced versus the reward at this point.
The market's been fighting off kind of recession talk now for 2 or 3 years.
Tariffs and consumer sentiment are the big issues that are likely going to be depressing most retail stocks for the weeks and months to come.
The strategists are getting negative. The traders, the investors are nervous about what this means.
If sustained, these types of tariffs could shave minimally 7/10 off of growth for the year, maybe even a full percentage point.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The third hour of Bloomberg Surveillance starts right now, and this hour you've got some economic data. About 15 minutes from now, we get the ADP jobs data. Look out for that. Later on this morning, ISM services. Why is that data point so important? Because earlier this week, ISM manufacturing beneath the headline number was really soft. New orders, not good. Employment in contraction. Prices paid creeping higher. That is going to be one to watch a little bit later. In the equity market right now, equity futures shaping up as follows on the S&P 500, on the NASDAQ, on a Russell. A bounce this morning. On the S&P up by 0.2%, on the NASDAQ up by 4%. The why? The potential for a compromise, Lisa, on trade between the United States, Mexico, and Canada.
There was a fear yesterday that maybe this was it, that 25% would stick in terms of the tariff terms for Mexico and Canada, and this was just the beginning. If there is a relief valve, that will give markets confidence again that they haven't had in the past couple of trading sessions.
So we begin this hour with markets bouncing as the Trump administration signals a deal could be reached to relieve tariffs on Mexico and Canada. Joining us now is the man behind the negotiations, the 41st United States Secretary of Commerce, Howard Lutnick. Mr. Secretary, before we get going, a warm congratulations from the team here at Bloomberg Surveillance on your confirmation.
Thanks so much. And wasn't last night's speech amazing? I could have been more proud of President Trump.
We'll get into the niceties on that in just a moment. Let's kick it off, sir, with a question about your comments yesterday, when you suggested that maybe there could be a compromise on trade between the United States, Mexico, and Canada, and maybe we'd hear more about that today. Has the president confirmed that? Is that still the plan?
Well, I think what happened is you have the trade ministers and all the people from Canada really working hard with our Homeland Security people Remember, this is not a trade war. This is a drug war. We've got fentanyl still pouring into the country, and it's got to stop. So what's happened is they're showing us even more ways to try to stop the flow of fentanyl. And if they can stop the flow of fentanyl, the president is open-minded. There are going to be tariffs, let's be clear. But what he is thinking about is which sections of the market that can maybe he'll consider giving them relief until we get to, of course, April 2nd. But I don't want anybody to forget, April 2nd is the day that we announce our reciprocal tariffs around the world. And so April 2nd is coming, but this is about fentanyl this month.
Got that. Just want additional clarity. Just to be very clear on this. Yesterday when you said, I think the president's going to figure out, you do more and I'll meet you in the middle, we're probably going to announce that tomorrow, as in today. Can we no longer expect that announcement?
No, I didn't say that. I said the president is listening to the offers from Mexico and Canada. He's thinking about trying to do something in the middle. He's thinking about it. We're talking about it. When I leave here, I'm going to go talk about it with him. And I think early this afternoon, we expect to make an announcement. And my thinking is it's going to be somewhere in the middle. So not 100% of all products and not none. Somewhere in the middle, because I think Mexico and Canada are trying their best, and let's see where we end up. So I do think somewhere in the middle is a likely outcome.
When you say somewhere in the middle, do you mean somewhere in the middle on tariffs, as in somewhere between 0 and 25, or do you mean that certain groups, certain industries will just get a carve-out? And would that carve-out be, say, the autos? Because the president mentioned last night he'd spoken to the autos CEOs. Is it carve-outs we should be thinking about here?
Yeah, I think it's by product, by region. Remember, the USMCA, right, the United States, Mexico, and Canada agreement set up some policies that said you've got to have a certain amount of U.S. content in your products to be USMCA compliant. So I think he's thinking about those categories, the USMCA compliant. And does that make sense to you, right? If you complied with the agreement, then maybe you avoid tariffs. And if you didn't comply with the agreement, well, you did so at your own risk. You knew you weren't complying, and therefore it seems likely that's a place where the president will go. Again, the president gets to make the decision. I'm there talking with him about it, and so is the team. But our expectation is that it'll be categories. It will be 25%, but there will be some categories left out. It could well be autos, could be others as well. USMCA, go look at that. That was the agreement we made with US, Mexico, and Canada, saying those products are exempt. Everyone who didn't live under those terms and did so at their own risk and knew they were doing it at their own risk always.
Secretary Lutnick, good morning. Would you say right now that you think that U.S. autos like GM and Ford are compliant under USMCA?
That is my understanding, is the big three say they produce cars that are compliant under USMCA, which means they have sufficient U.S. content in them to be part of the USMCA agreement. So I think that's part of our discussion, and the president's really thinking about that.
So it's fair to assume then, especially given the constituencies of auto workers that the president was able to pick up in this past election, that it is the auto industry that could potentially get that exemption later this afternoon?
It's not really an exemption. Remember, we're trying to end fentanyl coming into the country. So we're trying to send a message that fentanyl has got to end coming in from Mexico and Canada. It just has to end. And they've done a reasonable job on the border, and they're going to do a better job on the border. But this is, remember, it's a key about fentanyl for this month. April 2nd, we could talk about the rest. But this month, it's about fentanyl. And the president's trying to give Mexico and Canada some statements, some move forward, because they are trying their hardest, and we believe they're trying their hardest. But the fact is that we're going to put something on, because deaths in America have not decreased in a way that is sufficient. Deaths of fentanyl and opioids in America.
Many families will sympathize with this remarks. Me, myself, I know families who have been at the end of the suffering when it comes to fentanyl. But yesterday, though, the president questioned the fairness of Canadian banks. So what is it about? Is it about Canada's banking system, or is it really about fentanyl?
So this month, right now is about fentanyl. When we talk about April 2nd, we will talk about the bigger trade picture between our trading partners, Canada, and our trading partners in Mexico. So April 2nd, I'll be happy to come on and talk to you about our thinking and our thoughts about a broad trading model. But right now, it's about fentanyl. This is a drug-related issue. Drugs coming into the United States of America have got to stop. The border has got to remain closed. That's the key of how you treat your great trading partner. You treat your great trading partner with respect, and you stop letting fentanyl into the country. So my view is the president is thinking about it. He's thinking about autos. He's thinking about USMCA. He's going to come up with a plan this afternoon. We're going to announce that plan. I think it's going to be in the middle somewhere. There's going to be 25% tariffs. It's not the middle as in a number. I think it's the middle in terms of USMCA and not USMCA. But the president will decide that this afternoon, and then we'll go on from there. But think about that. If you were compliant with USMCA, you did what President Trump asked in his last term. And if you weren't compliant, you did that at your own risk.
Secretary Lutnick, I just want to make sure that I understand this correctly. You're talking about the idea that this all has to do with the drug wars, and at the same time, some people have speculated that this could lead to a renegotiation of USMCA that would lead all around to even lower tariffs than before. Are you saying that's off the table, that tariffs are still part of this at the 25% level?
Well, remember, April 2nd, we begin our reciprocity model, which is how you treat us is how we treat you. And that is going to be part of his exemption, part of his tariff policy. And then he's got industries, autos, semiconductors, pharmaceuticals, steel and aluminum and copper, lumber. These issues need to come home. We need to help our domestic industries grow and flourish. And so we called out those product sets for extra focus. But that's April 2nd. So on April 2nd, our reciprocal trade policy will come out. In 2026, we renegotiate USMCA with Canada and Mexico, and we're going to have really clear analysis and clear focus on how that changes. But right today, let's be clear, today is about fentanyl.
We heard from last night the president. He said that he was fine with a little disturbance, but going forward, there will be all of these gains realized. Secretary Lutnick, are you concerned about the level of uncertainty expressed, not just in markets, but just even from people who you used to work with, where they're saying, we don't have a clear sense of what the goal is? And I understand you're saying it'll come on April 2nd, but in the meantime, people are just putting all plans on hold.
Well, I'm not seeing all plans on hold. In fact, I'm seeing the opposite, right? We saw Apple commit to $500 billion. We saw OpenAI and Oracle commit to $500 billion of investments. TSMC just the other day saying $100 billion investment in America. SoftBank, $200 billion investment in America. So $1.3 trillion, and you think people are waiting on the sidelines? We feel it every day. All these companies are coming. They're building in America. They're committing to America. We agree April 2nd is coming. We have to do our work before we announce our plans on April 2nd. Of course, we have to do our work and do it properly and do it thoughtfully. But in this period of time, America needs a president to protect people from fentanyl. It shouldn't be killing people in our country. China still has fentanyl as a highest list of subsidies. Subsidies. They subsidize the production of precursors, the ingredients to fentanyl. They send it to Mexico and Canada, and into the country it comes. So our president has said, enough already, enough already. And that's why he's come up with this tariff plan today. April 2nd will be a fairness plan. And fairness plan is not that hard to figure out. If you have a
Secretary Lutnick, can I jump in there on the fairness plan? Is that an initial partial assessment and response, or will tariffs actually hit on April 2nd?
Well, there are a whole variety of laws in the United States of America that we will follow with precision. Some tariffs will come on right away, and then some tariffs will be registered, and they will take 3 weeks or 4 weeks, and they will come on in due course. So there's a process for tariffs in America, but we will announce them and we will be negotiating with all these countries thereafter, and then they go into effect over a period of months. So basically,
Because,
April 2nd,
as you know,
we will announce them, and then they come in.
Because there's months of studies, massive report, public opinion. This can take a very long time. So legally, there's no law that's short enough, really, to put tariffs in place on the 2nd. So how long between April 2nd until the tariffs actually hit do you think we'll see?
As I said, we launched our studies on January 20th. So April 2nd, those studies are done. Some tariffs can come straight away. Some can come weeks later. Some can take over a month or two to come online. But it will be very, very thoughtful, very organized. And we begin on April 2nd. We've announced it from January 20th that April 2nd was the day. We're sticking with our day. We're sticking with reciprocity. It is time for America to be treated fairly. And that's what President Trump is going to do. He's going to make sure we are treated fairly. He's talked about it last night. He's made this clear. So Mexico and Canada is about fentanyl today for the month of March. But on April 2nd, it's about fairness. And yes, that is a process that comes in that is strictly specific